To hear a definitive response from Europe. We might not get that early this week. That might come later. European leaders are meeting later on this week. But of course, whether we see retaliation there will be important to US stocks later on in the day, of course, as well. Euro Stoxx 50 futures then, Tom, are negative, down by 1.6%. Take us through some of the stocks we're focused on.
Some of the individual names that are in focus for us today. This is one story that's not, in fact, linked to the tariffs, which is Bayer, and this is on the back of a ruling that came through on Friday. It could be significant for this company and others within the chemicals and fertilizer space. This is the US Supreme Court agreeing to hear that German company's appeal, taking aim at those thousands of lawsuits that have been targeting, of course, the Roundup weed killer. So that is important for Bayer. But beyond that, it is all about tariffs and trade. That is the key driver. So watch for the luxury stocks, LVMH in focus, the automakers as well, on the threat of additional tariffs on those goods being shipped into the US market, Anna.
Yeah, and we've already heard from Europe that the ink is not yet dry, not even been signed on the trade agreements that have been made across the Atlantic. Now, they have been put on pause. That conversation with the European Parliament put on pause, not approving those and considering dusting off some other measures, some tariffs on US product instead, up to the value of 93 billion euros, we understand. Let's have a look at how European equity markets are dealing with this new renewed tariff news flow. Yes, last it was very much dominated by the tariff conversation, of course. Certainly the month of April, very much dominated, and we worked our way from there through a lot of the issues around tariffs. Maybe we thought we'd park tariffs a little bit for now. Maybe we thought things were more predictable. It seems that was not the right assumption, and things are not predictable when it comes to the tariff conversation. And now we see tariffs weaved in with the geopolitical agenda surrounding Greenland, and that is to the negative for European companies. So the Stoxx 600 down by 1%, the FTSE 100 down by 0.5%. CAC stocks over in Paris down by 1.6%. The IBEX also a little bit weaker. Waiting to see what happens on the DAX and on the SMI. We could get some weakness on the DAX, of course, because of some of those auto companies that you were talking about, Tom, just a moment ago. The SMI, well, the Swiss currency might behave as a bit of a haven. We were hearing from Goldman Sachs earlier on today. We'll see what people decide to do with the drug sector, with food and beverage companies, whether there will be any havens to be found within European stocks, or we have to look to other assets, to bond markets, for example, to find those, Tom. What are you seeing in the sectors?
Yeah, we're seeing that divergence as well at the index level. Interestingly, to your point, the FTSE 100 down 0.4%, but bearing and faring much better than its continental European counterparts, despite the fact that the UK is targeted, of course, by those tariffs as well. On a sector basis, the worst selling is coming, the strongest selling coming through for consumer products, down 2.3%. Banks also, interestingly, under pressure. 1.7% is the drop there across that sector. Financial services, technology, all being hit, all down more than 1%, significantly more than 1%. Travel and leisure down 1.4%. In terms of sectors in positive territory, just one sector so far. That's personal care and products, just marginally gaining. Utilities, often a safe haven tilt into utilities. That sector is down 0.3%. Again, one of the least bad performing. The defence names are on the rise. You're seeing that with the FTSE 100 and BAE Systems, Anna, gaining a little over 1%, and its European counterparts in similar territory then.
Yes, the movement of defence often hidden within the industrial goods and services sector, but we certainly do see some defence names doing really well this morning. So Saab is up by more than 4%. Rent Group, Leonardo, Hensoldt, Thales, Dassault Aviation, Rheinmetall, all of those up by more than 2%. So where we are seeing selling in auto stocks and luxury, we are seeing gains coming through for European defence names, as I suppose Tom might depressingly expect to see on a day like today. Consumer products and services, then, obviously the luxury names are in there, and so that is where we are seeing some weakness. And you've been through some of the names there, but I suppose there is some defensiveness to personal consumption and discretionary and grocery stores. So Tesco's, M&S, Unilever are just a little bit firmer, but the gainers are few and far between today.
Again, that is leading some of those grocery names leading to that relative outperformance in terms of the FTSE 100. Again, still in negative territory, but some of those grocery names are doing quite well. Just briefly touching on the retailers, then Adidas down 4%, LVMH down 3.8%, Puma taking a hit down 3.7%. To your point as well, Hermes also under pressure by 3.6%, Anna.
Let us bring in John Turek, founder and CEO of JST Advisors, who joins us this Monday morning to think about the risk-off picture that we're seeing across global markets this morning. John, very nice to speak to you. So certainly very risk-off into the European session. European stocks looks as if they will come off worst, very much targeted by President Trump, of course, in those 8 countries over the weekend. How are you thinking about trade and tariffs and the tariff threat as we move into 2026 then? Does this reinsert itself back to the top of our worry list for European investors?
Yeah, and thanks for having me. And I mean, I think it has to. One, not only given the severity of sort of these tensions, as we'll probably hear more from this week, but also from the fact that, I think for a lot of allied countries who signed trade deals in the middle of last year, this is sort of a shock to the system in terms of, what it kind of means to what an agreement actually means. So I think it does, kind of bring it back to the forefront. I think, the bigger question for risk assets is going to be, we had this idea of taco last year, and is that sort of going to be the default parameter that we kind of operate under, or is this, something that's going to be a little bit stickier? And I think, really, I think this week we'll learn a lot in terms of how markets and their disposition sort of reacts to that.
Yeah, that's really interesting, because if we're thinking about the feedback loops, the feedback on the policy that President Trump will receive, it'll come from many places. It'll come from politicians globally. It'll come from domestic politicians. It'll also come from markets. US futures point lower, John. We will see how this plays out for bond markets, of course, because there's been some nervousness around the bond markets and the feedback loop that represents. What do you think President Trump will be looking at ahead of the midterms that might steer his course here?
Yeah, well, I think it's a very interesting tension that the administration kind of has to solve for, because they seem to have this, I would say, full-forced effort into not only juicing the economy into the midterms, but also kind of, this more grander vision of national resilience, reshoring global supply chains, and sort of, broader U.S. exceptionalism. The problem is that, to achieve some of these things, it's a very hard equilibrium to kind of strike. And I think the problem that the administration will have, especially, is what I kind of, differentiate tariffs between allied tariffs and adversary tariffs. And with allied tariffs, you have to deal with the fact that the allies own a lot of U.S. financial assets. And the question that we began to wonder last year was, either between hedging or outright selling, the U.S. could appear vulnerable if some of these larger pools of foreign capital decide that this is a little bit hairy. So I think the tension that the administration, I think, is going to try and toe, is U.S. exceptionalism versus, U.S. for sale. And I think that will be, something that will probably not be an either or. It'll probably be a balancing act, because I do think, it seems that some of these geopolitical and national security issues are something that are just very top of mind for the administration. I don't think it's a 10 bips sell-off in the long end or a 2% down day in the equity market that's going to, necessarily mean the end of these prerogatives.
Yeah, I mean, to your point, John, it's difficult to know who is an adversary and who's an ally at this point in terms of the perspective of President Trump. Do we get to a point where this cements, at least in the minds of some investors, a Sell America theme?
Yeah, so I don't know that it'll do enough to, a broad Sell America theme. I think, something that I've been, talking about in notes to clients is that, I think that the rest of the world came into this, Trump 2.0 world very leveraged, very long U.S. assets, and a lot of it being currency unhedged. And I think that, the question you have to ask yourself as a foreign investor is that even if you, don't want to necessarily part with, some of the big secular winners that have come out of the U.S. in terms of equity markets, credit markets, etc., it does seem like it does make sense to at least hedge a bit more of the FX exposure, especially as U.S. interest rates, at least in the front end of the curve, have come down recently. So I think that, I don't know that this is enough to kind of have a bigger rethink in terms of, not being exposed to the U.S. properly, especially as so much of the returns of financial markets over the last 10 years have been so U.S.-centric. But I think the question that is very reasonable to ask, especially for, I'd say these allied countries who hold a lot of U.S. assets with record low hedge ratios, is that the right mix for this sort of geopolitical landscape?
What assumptions and how does it change? How should it change our assumptions about the reaction function of the Federal Reserve, John?
Yeah, so it's a good question. I mean, I don't think it'll change that much right now. I think, the Fed is very much in wait and see. I think they probably have a slight bias towards labor market weakness being versus, too worried about inflation at this point. But, I think that, we're in over these next 2 months, probably in the peak of sort of this tariff impact on the price level. And the question is that if the tariff playbook is sort of back in play and the go-forward rate of tariff could actually be higher, is that this is going to be a little bit more lingering when the Fed thought, by the middle of this year, that price level adjustment would have been done. But I think in the near term, I think, the labor market is still a little bit more front and center, given that the inflation pass-through from tariffs has been, I would say, more muted than versus expectations.
Can I ask you about FX markets and how they are going to respond here, John? We've talked this morning about how the dollar has come off as the loser, and that does seem to still be the case. Looking at the Bloomberg Dollar Index, the DXY, both of those have the dollar down. The euro is gaining 0.2%, as if the euro gains, yes, they're there, but they're fading just a little bit. I wonder if the negativity around the start of trade here in Europe has anything to do with that, whether that weakness is sort of feeding off other assets. How do you expect this FX story to play out?
Yeah, it's a very interesting one right now. I think that, again, kind of coming back to my point earlier, it's these allied tariffs versus adversary tariffs. For adversary tariffs, I think the reaction is very simple, one, because they're oftentimes big exporters. It's FX weaker because it's, just the U.S. is much more immune to global trade concerns, given that so much of the economy is based off of domestic demand. But with the allied countries, they own a lot of U.S. assets. And, we've seen over the last, 7 to 10 years, this really massive buildup in the U.S.'s net international investment position. And I think that, the balancing act that FX is going to have to play with is that on the one hand, we could do this, quote unquote, sell U.S. theme on the back of just adding an incremental risk premium versus that, the U.S. is just, from an economic perspective, much more immune to both headline risk and global trading risk, given that, trade makes up a very small percentage of the U.S. economy. I think that, given the level of adjustment that could happen within FX hedges, I think that the dollar marginally should trade softer on these sort of headlines versus weaker, even though it could sort of exacerbate U.S. growth outperformance.
John, I want to get your views on Europe. I mean, we're seeing, again, defence names rallying today on that kind of geopolitical risk and expectations, presumably, that there's going to be more funding and more need for domestic providers of defence in Europe. There's a debate now as to whether or not the pressure from Trump catalyses faster and deeper reform. And we're seeing, at least across political boundaries, unity right now. And we'll see if that holds. Is it too early to start to think as an investor about how to invest along a more unified Europe?
Yeah, so I don't think so, to be honest. I mean, I think that, as we know from Europe is sort of, formed in crisis. We saw last year that the German fiscal announcement was very linked to sort of how the Zelensky White House meeting went. And that was obviously a very pivotal and monumental moment. And I think the question, that investors will have to think about, going into this year is that, the paradox of negative European headlines is that it can deepen structural reforms that are very much needed, both in terms of capital markets unions, continental integration, things of that nature. And that if Trump can sort of paradoxically be a bullish catalyst for some of these structural reforms, I think that's very top of mind for me going forward.
Okay, John, smart insights. Thank you for your time. John Churrick, founder and CEO of JST Advisors. Let's get you your core six then, on a day when we're weighing up these renewed trade tensions then between the EU and the US. We talked about the defence names performing very strongly. Here are some of the individual names as well standing out. Rheinmetall, there you go, the performance there coming through. 1.7% is the gain so far for that German defence company. ASML within the tech space taking a hit down 3% despite some positive upside, or at least commentary from Micron around high bandwidth memory. ASML, the maker of lithography machines, under pressure, falling the most across your core six right now, or almost in fact. LVMH is the standout drop there. The luxury goods maker down 3.7%. Novo also taking a bit of a hit within the drug space, down 2.7%. Schneider Electric also selling off, and Nestle off just 0.4%. Sometimes staples have that defensive quality, but Rheinmetall on the upside and the pressure coming through from LVMH. Let's get a check on some of the other individual stocks on the move and bring in Bloomberg's Jennifer Crew. Jennifer.
Good morning. We're going to kick off with a look at automakers. Automakers down in the red this morning. Volkswagen down almost 4%. Mercedes-Benz down more than 3%. That's off of the back of the news that President Trump is proposing 10% tariffs on 8 countries, including the UK, Germany, Sweden, countries that opposed his plans to acquire Greenland. Those car makers seen as particularly exposed to that directive. We're going to flip over to defense, of course, keeping in that geopolitical theme. Defense stocks up higher this morning. That's Fresnillo up almost 5% on the back of that news about those tariffs. Those companies seen as best placed to benefit to capture some of those orders from European NATO members, including Denmark. Those countries set to ramp up their military presence in the region, including in Greenland. We're going to flip over to miners, of course. That's Fresnillo, Anglo American, Glencore, some of those miners up as investors move towards those safe haven assets. Of course, there's a period of geopolitical uncertainty, investors looking for a bit of security on the back of that. Next up, we've got LVMH, of course. LVMH downgraded by Morgan Stanley, saying that a pause for breath is needed because of limited room for LVMH's shares to appreciate in the near term. LVMH seen as facing a lot of pressure, particularly in its wine and spirits unit, but also some pressure from FX and tariffs. Finally, we're taking a look at Bayer. We're ending on Bayer. That's after the US Supreme Court agreed on Friday to hear the German company's appeals for thousands of lawsuits alleging that the company failed to adequately warn consumers about the cancer risks associated with its weed killer. Those shares up 7% on the back of that.
Jennifer, thank you very much. Jennifer Crewe with the latest on some of those moves. We will also take a look geographically at what we're seeing across these European equity markets. And we've got some of the Scandinavian markets in particular under pressure this morning. So I can see that the Danish market, the Finnish market and the Swedish market under considerable pressure. The OMX in particular in Copenhagen down by 2.5% this morning. Coming up on the programme, we will check in on the European economic outlook and possible response to Donald Trump's tariff threats over Greenland. Our interview with ECB Vice President candidate and former Bank of Portugal Governor, of course, Mario Centeno. That's coming up next. This is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
You know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Every weekday from 3 to 5 Eastern.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
Welcome back to the opening trade. Happy Monday, everyone. We are 19 minutes into the Monday session. European stocks selling off then on this renewed tariff risk from President Trump around Greenland. 10% is the threat of additional tariffs on 8 members of the European Union, NATO allies, of course, from February the 1st. And we're looking at big moves, of course, across the exporters of Europe. The automakers, luxury, under pressure, but defence stocks are rallying. Talking of defence names, Germany and the finance minister there speaking in the last few minutes. We know that President Macron has called potentially for the use of the anti-coercion instrument that Europe has at its disposal. Now the Germans suggesting they could be supportive of that. The finance minister of Germany saying that a red line has been reached and due to Trump's provocation, Europe should look at how to use available tools.
Okay, thinking about how Europe responds, the European Union easing talks to potentially impose tariffs on $93 billion of US goods in response to President Trump's proposed levies on several countries over Greenland. EU leaders will hold an emergency meeting in Brussels later this week as Europe braces for one of the toughest tests of its transatlantic relationship. Let's bring in Mario Centino, who is running for Vice President of the ECB, former Governor of the Bank of Portugal, somebody, of course, who watches very closely the European economy. Mario, very nice to have you with us. Thanks for joining us. How should monetary policy makers, do you think, be reflecting on the news flow over the weekend?
Oh, thank you for having me. Europe and the euro area have entered a phase of structural uncertainty. This has been driven by geopolitical and trade tensions of the sort we have seen in recent days. But on top of that, we face competing fiscal demands related to defense, climate, and digital investments, and the prospect of abrupt changes in the structure of our economies and labor markets. These are not big, small challenges. So directly to your question, I think European Union institutions will increasingly be called upon to act as a stabilizing actor. And this very much applies to the European Central Bank and to monetary policy. It would be great if Europe can continue this coordination of policies that we achieved in recent years, because really the challenges are very, very big.
Okay. So monetary policy should act as a stabilizer, you think, Mario. What if European politics dictates that the Commission responds with retaliatory tariffs? How should monetary policy respond then?
Well, we have a mandate, which is price stability. Some of these policies and the shocks that we are facing, they have an impact on prices. So the best thing that could happen for all of us would be to each dimension of economic policy to do exactly what is expected for should continue to look for price stability. This is our mandate. But we do understand that it's very important for us to keep that in mind, that the coordination of policies helped us a lot to go through the COVID and inflation crisis. And these challenges that we face today are not smaller. So we need to, expect that this, how I put it, this stabilization anchoring from policy can really be on the table.
Mario, in terms of that stabilization of policy at the monetary policy level, if we do get to a point where tariffs are imposed between the US and Europe, should the ECB consider additional rate cuts this year?
Well, it's all about inflation and financial stability. We want to have financial stability because it is a prerequisite of price stability. If tariffs really have an impact in prices that will take us to reduce cuts further, that will be our job to do. So the important thing here is to understand that each piece of these common policies in Europe play together in a way that delivers for us, because that's quite important for Europe, the stability we need to go through these very difficult moments.
And we want to get to your candidacy, Mario, in terms of the European Central Bank Vice President role, and of course you'd be representing in that role, should you get it, the Southern Europe. What would you bring to the table? What kind of voice would you bring that doesn't exist right now at the ECB?
Well, it will be a voice that brings all this experience of dealing with very difficult challenges, the financial crisis as a minister, then as a governor, COVID and inflation. Also a voice of consensus. This is probably my most well-known trademark, is I'm striving always to get a consensus in a council that works in a collegiate way. So this will be my best credentials to the job.
That would be your credentials. And how do you assess your chances, Mario? Are you confident, quietly confident?
I mean, this is a very important day. It's up to ministers to do the selection. I think the large pool of candidates is a good thing for Europe, because there's plenty of choices. They are all my former colleagues. I have great appreciation for all of them. So honestly, I think it's just we should celebrate the fact that there are many alternatives around to be selected, and if each one of us concentrate on what are their specific characteristics and qualities to the position, that's I think what's important.
Mario Centeno, former Bank of Portugal governor and candidate for Vice President of the ECB. Thank you very much indeed. Coming up, we're going to speak to Leslie Finjamuri, President and CEO of the Chicago Council on Global Affairs. Stay with us. That is next. This is Bloomberg.
the Vivian Tom clientele.
Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world.
Why do you position your products for this group of women?
When I started, designing, I always want to do something that is empower women.
When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example.
My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s, so it's a more affordable price for them. And then, my powerful women's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
Earnings season is here.
Earnings season is upon us.
Can they surpass expectations? Bloomberg is first to break the numbers.
Taking a look at Starbucks.
Meta with the outlook.
eBay also reporting earnings. More earnings to get through.
With the smartest insights.
You start the year at 22 times forward earnings. You're just going to have a more sensitive market.
We're probably going to have another good earnings season.
And our conversation continues here on Bloomberg.
Continuing coverage on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
This is the opening trade. We are 30 minutes into today's session. This is the market reaction then to that economic coercion from the Trump administration. European stocks across the benchmark down 0.8%. The DAX, despite the defense names performing quite strongly in the session today, as an index falling more than 1%. There's relative resilience in the FTSE 100, and defense is playing its part there with BAE Systems gaining down 0.1% just for the FTSE 100. The CAC current over in France dropping 113 points. Let's flip the board and have a look at what's happening in terms of some of the volume on a day, of course, when the US markets are closed for a national holiday. So of the 600 across that benchmark in Europe so far, I touched on volume, so let's start there. Actually up. Volumes are actually up about 40%, in fact, despite the fact that the US is closed for that market holiday. But all that uncertainty around the tariff risk and threat from the Trump administration. Across your 600 members then, just 116 in positive territory, and we'll get into who those are. On the downside, 473 stocks now under pressure and selling off in the Monday session. Let's flip the board and have a look at some of the leaders then. I talked about the defense names on that geopolitical risk, the focus on Greenland, the threats of military intervention. Rheinmetall at 2.4%, that German defense company. Of course, BAE Systems here in the UK gaining more than 1%. And Bayer, this is separate to your tariff story. This is separate to the Greenland story. This is on a ruling from the Supreme Court in the US that they will look at those cases targeting Bayer. So that is seen as positive for that company. Gaining, look at that, almost 8% in the session today. On the downside, we expected this, of course, on the Trump tariff threat. The exporters to the US market with 10% additional tariffs potentially kicking in on February the 1st. So the luxury makers, LVMH down 3.8%, Richemont falling 3%, ASML as well. Tech is also under pressure in the session today, and so the maker of those lithography machines down almost 2% as well. The Dutch company not immune to the pressure coming through in this risk-off environment. Anna.
Tom, let's get an update on some of the other stories this morning, and we start with a story outside the world of business and finance. A high-speed train has derailed, jumping onto the opposite track and slamming into an oncoming train in southern Spain, killing at least 36 people. The crash happened last night when the tail end of a service travelling from Malaga to Madrid went off the rails near Cordoba. Former UK Prime Minister Tony Blair, who's been appointed to the executive panel of Donald Trump's so-called Board of Peace, has distanced himself from the president's demand that countries pay $1 billion for permanent membership. Separately, Israel has voiced objections to the makeup of the Gaza Committee, which sits under the Board of Peace. And Bloomberg has learned that the European Union is in talks to potentially impose tariffs on 93 billion euros of American goods. That's if US President Donald Trump follows through on his threat to hit several European countries with a 10% trade levy. EU leaders are set to hold an emergency meeting in the coming days to explore possible retaliatory measures. Tom.
Let's head to Brussels right now to get more on that story. Let's bring in Bloomberg's Chief Europe correspondent Oliver Crook, who's standing by. Ollie, we've been hearing from the French, we've been hearing from the Germans, the French finance minister saying a red line has been crossed in terms of France le secure. Over in France, saying that minister saying we need fast and significant reaction to Trump. So for now, there is unity in terms of pretty sustained pushback, at least rhetorically, and whether or not they reach for that so-called bazooka in Europe. Talk to us through the European reaction to this tariff threat.
Yeah, I think it's one that's been overwhelmingly of European unity in the response to Trump and those comments that we got on Saturday evening, basically imposing 10% tariffs from February the 1st on 8 European countries, including France and Germany, Denmark, Sweden, United Kingdom, Netherlands, and some others, basically for their support that they have lent to Greenland in the form of basically symbolic military presence in Greenland, which is about sort of building out security there, which is, of course, at the behest in some way of the President of the United States. That 10% tariff goes to 25% tariffs in June. And I would say that what has marked the difference now between the trade war that we saw earlier between the Europeans and the Americans is the rhetoric here from what we're hearing from the Europeans is much stronger. I think that with the trade imbalance question previously, which is what the Trump administration was trying to write, it was fair to say that there was trade imbalance between Europe and the United States. This is not seen as a legitimate way by the Europeans to use the trade tool, not to rebalance the trade balance, but actually to exert basically geopolitical pressure on the Europeans. And so the word we keep hearing over and over again, we've just heard it from the French, we've just heard it from the Germans, is blackmail. So the question is, how will the Europeans respond? Is this the red line that will cause the Europeans to finally push back? They've really rolled over the past year of Trump's presidency, giving the president basically everything that he wants. But it's hard to imagine a world in which you get February the 1st, 10% tariffs, and then the Europeans can't respond. What we know they have locked and loaded to go is about tariffs on about 100 billion euros worth of goods. That's ready to go because from their negotiations from early in the year, there's this issue of the anti-coercion instrument that the Europeans could deploy in order to basically move more quickly on a number of different trade issues, but also U.S. tech companies. But I think for the Europeans, it is sort of being thrust into focus right now. If no deal with the Trump administration is final, how far will appeasement take you? And that is exactly the balance of risk that is going to be on the table for European leaders who will be meeting here in this building on Thursday, and European finance ministers convening today and tomorrow, who we're going to try to get some questions to figure out how to respond here from the Trump administration.
Yes, the response is going to be all important, isn't it, Ollie? And will it be different to last time? With that in mind, and thinking about the drivers, the motivation behind what President Trump has done here, lots of European leaders asked to speak to President Trump over the weekend after he made this tariff threat. Norway and Finland amongst them. They sent a letter asking to speak to President Trump. In response, they received quite an incredible reply, a letter from the US president. Take us through some of the detail there.
Yeah, a very remarkable letter from the President of the United States addressed to the Norwegian Prime Minister Jonas Gahr Støre, and I'll just quote from it. It's fairly short. He said, "Dear Jonas, considering your country decided not to give me the Nobel Peace Prize for having stopped 8 wars plus, I no longer feel an obligation to think purely of peace, although it will always be predominant, but can now think about what is good and proper for the United States of America. Denmark cannot protect the land from Russia or China, and why do they have the right of ownership anyway? There are no written documents. It's only about a boat that landed there a few hundred years ago, but we have boats landing there also." So add that to the list of reasons why Trump wants, jurisdiction and sovereignty, control over Greenland. There's, of course, the Arctic threat that is seen as a sort of legitimate concern by the United States, and I think the Europeans agree, which is why they want to negotiate with Trump on that point. There's the question of mineral resources. There is also the question about Trump legacy, expanding the borders of the United States. But if the real reason is that basically Trump didn't win the Nobel Peace Prize, I think very few people people, certainly in Europe and probably around the world, see that as a legitimate reason to sort of eschew the goals of peace in order to take control of Greenland. And we should say that for the Norwegians, they also have a strategic island in the northern Arctic. So there is also a question about their own sovereignty that is somehow implicitly linked in this conversation, to say nothing of Canada. If the United States is saying, basically, we need control over the northern part of the globe, Canada is part of that in order to get out the Golden Dome, where is the sort of limit to how far he's willing to go? And that is a question for European leaders, but also for other leaders, including Canada.
Ollie, thanks very much. Bloomberg's Oliver Crook then at the European Council with the latest on the European response and some of the dialogue that's been happening between Europe and President Trump. Let's bring into the conversation Leslie Vinjer-Murray, President and CEO at the Chicago Council on Global Affairs. For more, Leslie, really nice to see you in studio with us today. Looking forward to your analysis. And let's start with that question we were discussing there with Ollie, the motivation behind what President Trump is doing here. Quoting Greenland, of course, extensively, and we've heard a lot from the president on that subject. Also, the Nobel Peace Prize now. But if we stick with the Greenland story, is it possible that President Trump has seen EU NATO members sending a few troops to Greenland as something threatening when actually Europe had meant it to demonstrate the seriousness that they treat Arctic security? I mean, is it possible that that is a misunderstanding that has happened here?
Absolutely. I mean, I would have thought, I think we all would have thought that this would be seen as Europeans doing more for defense and security. President Trump has clearly wished to see that. And instead, he's taken it as an affront that Europeans are challenging the president. And he's clearly ratcheting up and accelerating the threat. And so, you know, the risk right now for Europe, I think, is how do you manage this president? And there's clearly a rapidly developing sentiment across European leaders, across European publics, that Europe should come together and take a strong line, that this will win the day. And the example is being drawn to China. And others who have been more effective, especially at China, I think. But, you know, there's a critical distinction here, which is that China has had real leverage with its threat to withhold the export of rare earth critical minerals. Europe doesn't have the same leverage, and so it's a very different calculation. It's not only clearly unity is important, clearly a clear response is important, but I think, you know, sort of taking that case and plopping it onto the European case risks an escalatory trade war, which would do everybody harm. I think the other thing is to note that American consumers are increasingly going to bear the cost of tariffs. They didn't in the beginning. Towards the end of 2025, it was sort of looking at 50% costs deflected to U.S. consumers. We're looking at 60+%. So working through American consumers is, you know, it's a long-term play, but it's probably a good one. Americans don't like what's happening in Greenland. They're not on the side of the president on this issue. So I think some really nuanced thinking is absolutely essential.
And what kind of response is President Trump going to get from Republicans, from his own party? Some of that response that's been highlighted over the weekend has been quite critical. I wonder how that is going to feed back into his thinking.
Yeah, and so here, you know, the Republicans are dividing slowly on this. We've seen some divisions within MAGA on other issues. This is putting them in a very difficult spot. I think in general, you know, if you were to talk to people privately and they were honest in the Republican Party, they would say they did not support this policy. There's no material reason that the United States needs to take over Greenland or possess it. Using military forces, widely opposed. But the question, as we know, for the past year has been who will speak out. And again, domestically, Americans, Republicans, what levers do they have to constrain the U.S. president? We're waiting for that Supreme Court decision on tariffs. If that ruling is against the president, that, you know, that produces a delay. But, you know, coming back to this question of Europe and tariffs, there are two very interesting, significant products that Denmark exports to the United States. 100% of Ozempic comes to the United States. It comes from Denmark. 74% of insulin. Those are really critical products, differently critical, but really important products for vast swaths of Americans. Insulin clearly critical for the American health system. So there are levers, but it could be very risky to pull those levers.
Yeah.
So the European drug makers, or at least weight loss drugs, could be our rare earths. As we look at the Chinese example of how to push back, maybe that's taking it too far. But there are levers.
There are levers, but there are workarounds. We know that there's a crowded market. There's a developing market.
Eli Lilly might be happy with that turnaround in events if that was to come. Would you be advising European governments to go for that so-called bazooka, that anti-coercion instrument?
So, I think you need to drill down on that. I've heard some people say that the anti-coercion instrument is not nearly as strong as it's made out to be in the media right now. So, real question about what lever that is. And again, I think this is a moment for very, very savvy diplomacy, and there's likely to be a gap between the rhetoric and actually the instruments that are taken. And now, once you've got the European public, when you start talking about sovereignty, as you well know, Greenland and Denmark, you get the public angry. And so the European leaders are going to have to manage the public, their publics. They want to see a stronger response. The unity is critical, but my fear is that this could lead to a very, very escalatory trade war, which would have very negative impacts on Americans, on American consumers, on Europeans, and comes at a time of great security challenge. So one doesn't want to see, the word appeasement not appropriately applied, but one doesn't want to see appeasement. But at the same time, Europe is not in the same position as China. It is a very tricky set of calculations right now.
How do you think Beijing and Moscow will be reading these events?
I mean, wonderful distractions. China, as we know, has got its eyes on the prize of global leadership, of its developing its economy strategically, managing Donald Trump very effectively. I think we are all surprised over the last year, and as reflected in the national security strategy, that the U.S.-China relationship is actually moderated. But when they watch Europeans fighting with Americans, hooray. I mean, a big distraction from the things that they wish to accomplish. And again, with the war in Ukraine ongoing, it takes America's eyes off the prize. It takes Europeans' eyes off the prize. It's really essential to get the transatlantic relationship back on track.
Yeah, but what do you think the word ally means in Washington these days, Leslie? Does it have any meaning at all? I mean, if you trained in the world of business, then maybe it's a term that you don't see as all that relevant, and maybe that's what we're seeing playing out in politics right now.
Look, the word ally, it's a formal definition, and it's about the security part of the relationship. It's not, partners or kind of cover the broader relationship. But I think it's really critical to recognize the moment that we are in. Donald Trump is a singular leader, and he does not reflect, and we know this, right? The Chicago Council on Global Affairs has been polling the American public since 1974, and the American public's views are very strong on NATO. They don't wish to see military force used in Venezuela, in Greenland. The President of the United States does not track either with the broader Republican sentiment or with the Democratic sentiment or with the American public on numerous things, even though people have clearly folded to support him because he's got a huge amount of power and he's willing to bust through those norms in ways that are, quite frankly, threatening to people's individual security. So this is the challenge, and I think we all know that at the end of the day, getting the president to moderate in any meaningful way is something that Americans are going to have to do.
Do you think the bond markets played a role in April of last year when tariffs on Liberation Day were announced? We're not seeing that kind of reaction today, and the level of tariffs is not at the same point. But at what point we're talking about the domestic political constraints potentially on President Trump's aspirations? Do you think the markets start to play that role as well, or has Scott Bessent now been pulled so firmly into Trump's orbit that even he is not going to be the one putting pressure on this president?
Americans at the high end, those invested in the stock market, are doing very well, the growth in the economy is very good. The jobs are, the rate of job creation appears to be coming down. That could affect people. And so I think you've got to differentiate between, upper middle class and wealthy Americans who are benefiting and those ordinary Americans who are feeling the affordability. The word of the day in the United States is affordability. This is where people are unhappy. This is where the administration has so far not delivered. But how does that actually have any sort of effect on the president? Not until the midterms. So there are very few points in which that sort of ordinary swath of Americans have real leverage, have real influence, and elections are the primary mechanism. But for now, broader pressure, the economy is doing very well. Everyday life, I can tell you, in the United States, we see and we hear and we know the stories about ICE. Everybody's watching Minneapolis. The president's considering using the Insurrection Act, potentially sending 1,500 troops in. The streets of Minneapolis are extraordinary to watch. It's upsetting to people, but you've got a country in which many wealthy Americans are doing phenomenally well, and therein lies attention. Without that changing, it's hard to see the president moderating. He's delivering for the high end of the United States.
Okay, Leslie, thank you very much indeed for your take on what is happening and how to think about it in a broader context. Leslie Vinjamuri, President and CEO at the Chicago Council on Global Affairs. Let's get back to the market reaction then. We've been talking about the fact, of course, that it is risk-off given those additional tariff threats coming through from the Trump administration, down 0.8% across your European benchmark. You are seeing gains, though, of course, for European defence names as a result of some of these tensions and fears maybe around what happens with the NATO alliance on the back of this. So you've got the likes of Saab, Hensoldt and Rheinmetall posting decent gains. On the upside as well, Bayer up 7.6% on a Supreme Court ruling. That's a picture across the European equities. Broadly, of course, it is selling pressure across the European markets on these tariff risks. Let's get you to break. We'll get more analysis across the markets as we square up to this economic pressure. Stay with us. This is Bloomberg.
Here is understanding. These digital assets have the ability to change the payment landscape of the world, and we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading cryptocurrencies. What we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoins?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need, because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute aerospace news whenever and wherever it happens. I'm Guy Johnson at the Dubai Air Show, and this is Bloomberg.
Welcome back. This is the opening trade. Staying with our top story, Donald Trump's threat to impose tariffs on 8 European countries is shaking the foundations of the EU and NATO alliance. European leaders have strongly rebuked the threat, calling it blackmail. Defence stocks, then, as we may have expected, are on the rise this morning. Let's discuss the defence supply chain, what this means for European defence, with our global defence editor, Jerry Doyle, on set with us here in London. Jerry, good to see you. So do we take from the developments over the weekend that, you know, there's more pressure on Europe to spend more on its own defence? Clearly, that's been the message for a very long time, though, now from the Trump administration and the first Trump administration. Does this mean less reliance on US defence names? What do we conclude from the weekend's developments?
It certainly seems like we're on that sort of a trajectory. If the U.S. sort of continues down this path of insisting that it needs to own, to take Greenland by force as necessary, that sort of, you know, shatters a lot of relationships, both at the governmental level and the military level. And it makes it very difficult for current European customers of U.S. defense companies to believe that they can continue getting the support and the parts and the other sort of supplies that they need to maintain complex weapon systems like jets, you know, advanced missiles and things like that.
What is the level of reliance right now on that U.S. military input into the European supply chain, and how easy or not is it for European defence contractors to find additional sources, either within Europe or places like Korea, for example?
It depends on the system. Something like Patriot missiles, there isn't really a European analog for that at the moment. There's sort of lower-end defense systems for air defense that you can get from Rheinmetall and Kongsberg and other European companies. But, you know, a Patriot system that can intercept missiles, that's a little bit harder to replace. And then you have something like the F-35, a fifth-generation fighter. There are no other foreign suppliers of that in the world right now. If Europe wants a fifth-generation fighter, it has to have the F-35. Of course, European companies also make lots of different components of the F-35, so that complicates the supply chain from a different direction.
Okay. Joe, thank you very much indeed. As we look at European defence companies rallying in the session today, our global defence editor, Jerry Doyle, on some of the complexities around the defence supply chain. Let's bring in another view on the broader markets right now. We're joined by Skylar Montgomery and Koning. Skylar, we're seeing risk-off across the global, or at least across European equities. We lift the hood, and there's some idiosyncratic stories at play as well. Gold and silver getting another lift. Bond markets, not a huge amount of action there. What for you is the central focus right now across these the market reaction to this?
Yeah, I mean, it's quite interesting. I think the number one kind of feed through is the growth channel, right? Because if you have higher tariffs, that's negative for growth. So you're seeing that very clearly within equity markets, and particularly within the sectors that will be most impacted. So I think it's interesting that you are getting kind of a more targeted market reaction in terms of autos aren't doing as well, defense is doing better. UK is doing better than Europe because there's more miners and you have gold there. And it's not this kind of broad sell-off everywhere. It does seem to be very targeted because these aren't as big as the tariff threats we've had previously.
Yeah, that's interesting. And does that explain why government bonds are not quite the haven that they've been? I was expecting to see a bit more flight into German bunds, for example, and we're not really seeing that. We're seeing a bit at the short end, but just 2 basis points of a move in German yields.
I think that's partly where do I want to hedge. I want to hedge mostly in commodities because that's the main feed-through channel, and I think that's market's expression for a while now. I think the other issue is that we've been here before, right? We've had the taco trade. We don't know whether this is sustainable. The actual implementation date is until February 1st, so we don't have tariffs actually being implemented right now. And the worst case scenario is that we do have a 25% tariff put on Europe, which isn't as bad as what we've had previously. Now, you could talk about much, much worse scenarios, but again, those are low probability, high impact events that are very hard for the market to price.
Yes, I mean, the euro is a little stronger this morning, Skylar. Does that sustain, do you think?
I don't think so. I mean, we saw last year a very big flip in the dollar's reaction function and euro dollar as well to tariffs. So initially on Liberation Day, when there were broad tariffs imposed, the market reaction was that it was dollar negative because the U.S. was starting a trade war with everyone. Yeah. So all U.S. exports would be impacted versus just European exports to the U.S. What we've seen is that because the U.S. has more bargaining power, these other countries have been willing to take on higher tariff rates and the economic cost, especially because they are more export reliant versus the other way around. And so this is just the U.S. versus Europe. And Europe is more strong.
Thanks, Skylar. Skylar Montgomery-Koning from our Markets Live team. That is it for the opening trade. The Pulse is up next with Francine Lacroix anchoring live from the World Economic Forum in Davos. This is Bloomberg.
studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Burden in Florence, Italy, and this is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Every weekday from 3 to 5 Eastern.
Only on Bloomberg. Context changes everything.
Good morning, everyone, and welcome to The Pulse, live from the World Economic Forum here in Davos, where conversations are dominated, of course, as expected, by President Trump's threats of tariffs on European countries opposed to the U.S. taking control of Greenland. Now, Europe is now considering its response, including the prospect of tariffs on more than $100 billion of U.S. imports. And the U.S. president is due here in Davos in a couple of days. Now, here's a snapshot of other influential voices that we'll be hearing from this week: the UK Chancellor, the head of the IMF, BlackRock's Philip Hildebrand, and of course the chief executives of Commerzbank, UBS, and Google DeepMind. Now, we also have some great guests coming up on today's program: the Franklin Templeton chief executive, Jenny Johnson, and Mikhail Roberts, the chief executive of HSBC Bank. But first thing is first, let's get straight to the markets. Stocks overall are in retreat as the Greenland fallout is lifting gold. Now, I'm looking at European stocks, but also U.S. futures. You can see them on your screen. They're falling, with havens such as gold rallying after Donald Trump threatened levies on countries opposing his plans to acquire Greenland. I'm looking at a couple of other things. Look, tariff concerns in all. We thought that that was a concern that was behind us, but they're now resurfacing at a time when risk appetite seems to also be supported by resilient corporate earnings and sustained investment in artificial intelligence. So in a moment, we'll be hearing from Jenny Johnson, and we'll talk about some of the geopolitical uncertainty, what it means for Wall Street and investments going forward. But first, the European Union considering imposing tariffs on $93 billion of U.S. goods in response to Donald Trump's proposed levies on several countries. EU leaders are set to convene for an emergency meeting this week over these latest actions, of course, escalating U.S.-EU trade tensions. Oliver Crook, our Bloomberg Chief Europe correspondent, is at the European Commission in Brussels. Ollie, good morning. So tell us a little bit about what's been threatened and what kind of response we're seeing from European leaders.
Yeah, the threat came on Saturday night here in Europe, in Brussels, and that's when we got that Truth Social post by the President of the United States threatening 10% tariffs beginning on February the 1st on 8 countries that showed their support for Greenland through these sort of small and really symbolic military delegations that they sent to Greenland, targeting the United Kingdom, Germany, France, Sweden, Finland, and of course Denmark and some others, and basically saying that if you do not get the process rolling on Greenland to getting possession to the United States, that we're going to up that tariff to 25% in the month of June. So that sets the stakes for the response that we got from the Europeans, which has been very sort of unequivocal and has been very unified, standing alongside Denmark, talking about the sovereignty of the nation. And the word that we keep hearing repeatedly, and we've heard it now also from the French ministers and German ministers, is the word blackmail. And the question is whether or not for the Europeans, we have now reached a red line of crossing from the United States. When you were dealing with the trade war last year and the trade surplus that basically the Trump administration that the Europe holds with the United States wanted to close, there was some sort of a thought that this is a sort of legitimate ambition for the United States to want to close that trade surplus. Now that it is basically tariffs are being enlisted to change the sovereignty of a European nation, I don't think anybody in Europe considers this to be a legitimate use of tariffs. And as a consequence, the Europeans will be faced with a very difficult decision and a very difficult calculation when they convene here. Finance ministers are meeting today. On Thursday, the leaders will be in this building to discuss the path forward after trying to get a diplomatic breakthrough with Trump, who will be there at Davos. The question is going to be, is it time to ramp up the pressure on the United States? And is that the cost that the European economies are willing to bear? And let's not forget that it won't just be an economic cost. There's also a ton of questions about the future of NATO, about the future of Ukraine and the U.S. support there. So these are all going to be the issues that the Europeans are weighing as they try to understand what the right response is to Donald Trump and to figure out and answer the question, is the sort of time of appeasing the Trump administration, is that now over?
Ollie, thanks so much. Oliver Crook there, Bloomberg's chief Europe correspondent. Of course, on how the European Union considering imposing tariffs on 93 billion euros of U.S. goods. That's $108 billion. We got our currencies correct. Now, this time last year, the chief executive of Franklin Templeton told us that President Trump would boost public and private markets, although few could have predicted the level of geopolitical uncertainty that we've seen over the past 12 months. Well, Jenny Johnson, the chief executive of Franklin Templeton, is with me now. Jenny, as always, thank you so much for joining us.
Great to be here.
I mean, I've had the pleasure this year of speaking to you a number of times, trying to understand what happens to markets, but also private markets, especially. It was telling for me when we looked back at the interview we had last year, which was 2 days after President Trump was inaugurated, about how much was expected for him to do in terms of investments in markets away from geopolitics. Where are we?
So actually, I think that what he had said at the time was he's going to reduce regulation and provide more clarity. So both in private markets, I think that's been a positive thing, as well as things like tokenization. And, both of those things he kind of stated from the beginning. Actually, you see sort of his game plan. A lot of the things, even today, the noise he's made, he kind of stated that from the beginning. So, in the case of private markets, like we've been big believers that you need to have fair access to private markets. And I say, it's akin to when my grandfather set up Franklin Templeton, the average investor couldn't get access to the equity markets. Today, the average investor doesn't really have access to private markets. And the size of private markets today, because companies are waiting longer to go public, banks aren't lending in the way they used to lend, that folks have been left out of that. And so I think with some regulatory clarity and a real desire to provide fairer access, the administration has done a decent job with that.
Jenny, I mean, we're also hearing from the administration things about, capping interest rates, and this goes back to the affordability issue in the U.S. How does that impact your world, but in general investment?
Look, I'm not a big fan of capping. I used to run a credit card department way back when, and it's pretty simple. There's three things that go into your cost of funds, the cost of operating it, and your loss profile. If you cap rates, it means that you cannot lend to as many people. So I don't think that's a great move. I think there's probably, it's great rhetoric to say, oh gosh, I'm going to reduce my cost there, but I think that's a tough one.
When you look at private markets, you've expanded really rapidly in private markets, but we've also seen outflows. So how much can you grow that to also bring inflows back?
We've actually had our best year. We raised $23 billion in private markets last year, and over 20% of that came from the wealth channel. Okay. And it's about bringing these types of products. You have to really structure the product to understand the individual's risk and liquidity profile. And so if we've been really focused on being able to do that. And sometimes that's a combination of public and private together in one product. Sometimes it's a perpetual type of product where you can get, 5% liquidity. So it's actually so far been a good year, and we're looking to this year to even be better.
What are you expecting this year? How much will you grow in that space?
So, well, we had laid out a plan that said we'll raise $100 billion over 5 years. We raised $23 billion this year, and we didn't have a big flagship product in the market. So this year we will with our Lexington Fund 11, and so we think it's going to be bigger. I think we've targeted, say, $25 billion this year. We love secondaries. We love secondaries because there's been so much private equity that has been deployed, and now they're not, the liquidity of those have not come out as fast as about half of what historically it's been. And so people are looking for a liquidity mechanism. Secondaries is a great way to do that. We love them structurally. They don't have the same J curve. You get a diversified portfolio. You get your cash flows earlier than traditional private equity. We also love real estate debt. So, you know, in private credit, a lot of people make tons of noise about private credit. I'm always surprised. You would never look at your fixed income portfolio as one big portfolio. You'd say, is high yield attractive? Is middle market attractive? Is asset-backed attractive? You need to think about your private credit portfolio that way as well. And so if you look in areas, we think real estate debt, because regional banks aren't lending the way they used to lend, is a great opportunity. We think asset-backed is looking very, you know, is looking like a good place to be, attractive. And so I think it's really important to understand you got to underwrite it like you would underwrite a fixed income portfolio. And manager selection in private markets is really important. The diversity of the top quartile performing and bottom quartile is significant. So you really have to pick the right managers.
Jay, how much volatility in general are you expecting? And actually, does that, again, because of AI valuations, I know there's a large presence of U.S. tech, because of geopolitics, because of these tariffs?
Expecting a lot of volatility. I mean, it is, right? I mean,
is opportunity or volatility?
It's always opportunity. Volatility is opportunity for active managers, right? And so, you know, look, this administration has shown us that there are surprises around the corner. And so you have to position your portfolio. You know, Franklin Templeton, we have clients in 160 countries. We're going to celebrate 80 years next year. We've been through a lot of administrations. Our job is to make sure our clients have their investment portfolio that is really diversified so that they can actually take these kind of short-term shocks. And if you do it right, you can get through it. And I think, you know, in the case of President Trump, look, think about what the markets did after Liberation Day. You know, we were all like, oh my gosh. And you know what? We came out pretty okay on the tariffs. China, it was going to be 100%, right? The markets reacted to that. A little less. You got through that. I think we'll get through this latest.
Is this because the U.S. economy is resilient, or I mean, the world economy is resilient, or?
Well, it's both that, and believe me, I think AI. We haven't even begun to see the impact of AI on individual companies. I think the next really exciting thing is the companies within sectors that actually get it right. They will take off, leaving the others behind in that sector. And so right now it's been the picks and shovels that have really been the ones that have gotten the evaluation advantages. It's going to be those companies that it takes time for them to figure it out. So that, of course, is part of the volatility. I think the other thing is...
Jenny, is it productivity that they work on, or just in general, like spending and, you know, to upgrade their systems?
It's going to be hugely transformative in the productivity. And by the way, you actually have seen in the U.S. companies, for a decade, productivity was running at about 1%. We're now closer to 2%. It's massive, which is why I also think you've seen not so many jobs created and yet companies growing, because we're getting, there are 157 million people working in the United States. We've had a 1% productivity. That's 1.5 less people that you need for the same kind of growth. And so definitely AI productivity, and I don't think that's in the numbers yet. I think that the productivity gains are from the technologies that have been kind of the last decade, cloud servicing, other things, digitalization. So the AI, it's going to take time. And there's going to be winners and losers in it. But the pace of it is so dramatic, faster than even I thought it would be.
Is it faster? I mean, is the next 12 months, 12 to 24 months actually crucial for that? Because that could also mean job losses, implications on the macro level.
So I'm always one to say, like, every time there's a big new technology, we predict that there's not going to be any jobs for it. And somehow, you know, like nobody would have thought Google would have 300,000 people and that there'd be all these new things that we have. So I'm always optimistic that way. Having said that, I think that when you say in the next 12 months, companies are going to invest in it to try to figure it out. There's going to be a lot of failures and dead ends in that process, but there's going to be learnings in that. And so I think that it's going to take a while for companies. And one of the reasons I ran the IT department for a long time, one of the hardest things about IT, you know, any kind of new application, I think, is people resist change. So your change management's tough. It's going to be hard to bring it into organizations. But the ones who get it right, it's going to be dramatic.
There's a big presence of crypto here. The chief executives, if you walk around Promenade, a lot of the houses are actually country houses. The Qatar has a big presence, some of the other countries, but then you also have a lot of the crypto exchanges. How do you see crypto getting more into the mainstream, and what does it mean for Franklin
Templeton? So I think 2026 is going to be a huge year where TradFi and DeFi start to come together, and I'll tell you why. So Franklin Templeton launched a on-chain money market fund. It was approved by the SEC in 2020. It's natively on-chain, which means we actually pay you your interest posted in your account every day. We can do that because it's on the blockchain. You can actually transfer, you will within the next few weeks be able to transfer on a Saturday from your money market fund into a stable coin. You can only do that because we are natively on-chain, right? The SEC had us run it parallel between our old system and our new system. We were astonished by how cost effective it was. And why do I think it's 2026? Because one, I just attended a crypto conference last week, is that you suddenly have the traditional financial people who are showing up to these things, and you have your crypto exchanges and others trying to launch traditional products, and you have your traditional financial firms saying, I need to figure out how my clients are asking me how to provide advice on this. How do they invest in this area? And so I think you're going to have these things start to come together more.
But this is because of support and blessing from the Trump administration. Is that a catalyst, or is it just the way that business was going to work?
So it has helped in the U.S., but there are other, Singapore, Hong Kong, the UAE, they've actually been much more advanced on kind of the regulatory environment, which was leaving the U.S., is because this is a technology that does really important things. Number one, it has a source of truth. There's a huge cost in financial services reconciling data within firms, and then once you have to reconcile with your counterparty. That's expensive. Number two, it has the ability to have a smart contract. If you own the token, whatever that agreement is actually programmed in it, so it's much more efficient. And then finally, it has a payment mechanism. We're going to see innovation on the types of investment products. We're going to see more financial inclusion because it's going to be less costly to be able to deliver financial products.
What about Bitcoin?
So Bitcoin's a different deal.
It's different, but does it translate into also bigger demand or more acceptance of Bitcoin?
So here's what I think about Bitcoin. I think that just like we're seeing gold take off, if you actually look at why gold has rallied over the last year, a lot of that is because central banks are starting to buy gold. Why? They want diversification from the dollar. I talked to folks after the U.S. froze assets from Russia. Not only did we freeze the central bank's assets, but we froze oligarchs' assets. And so there were people who said, wow, if we end up on the wrong side of that, that can be kind of scary. And so you see central banks diversifying. Well, the other option is you can diversify with Bitcoin. And you see the big countries where you had heavy inflation, Turkey, El Salvador, Venezuela, they were all actually big in Bitcoin. And so it's a way for people to get a certain amount of diversification. I always argue it's a little bit like religion, you're a believer or not. But those who believe view it as kind of a gold alternative.
Jenny, thank you so much for your time today. Jenny Johnson, the Chief Executive of Franklin Templeton. Now, coming up, we're expecting a news conference by the UK Prime Minister on how European allies might respond to the latest tariff threat from President Trump over Greenland. So we're expecting the Prime Minister to speak shortly. This is Bloomberg.
A multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Earnings season is here.
Earnings season is upon us.
Can they surpass expectations? Bloomberg is first to break the numbers.
Taking a look at Starbucks.
Meta with the outlook.
eBay also reporting earnings. More earnings to get through.
With the smartest insights.
You start the year at 22 times forward earnings. You're just going to have a more sensitive market.
We're probably going to have another good earnings season.
And our conversation continues here on Bloomberg.
Continuing coverage on Bloomberg. Context changes everything.
happened was you were off.
This week, live from the Alpine Mountains of Switzerland, is the World Economic Forum annual meeting in Davos. Bloomberg Television brings you unmatched coverage and conversations with world leaders, business executives, and billionaires as they navigate responsible AI deployment, economic expansion, and geopolitical tensions. Tune in for daily coverage all week. Context changes everything.
To the Pulse, everyone, live from Davos. Now, we're expecting a news conference by the UK Prime Minister on how European allies might respond to the latest tariff threat from President Trump on Greenland. With us now, Chad Thomas, Bloomberg's Europe Executive Editor. Chad, thank you for joining us. Look, you're in charge of our whole operation. We have many people on the ground. And President Trump will take over the stage on Wednesday, but it's all anyone's talking about. Tariffs, what it means for the economy. What are you looking out for?
Yeah, he's not just taking over the stage on Wednesday. He's taking over the event. He dropped a bombshell over the weekend, and that is the only thing people are talking about is this threat of potential tariffs over Greenland and a number of European countries. In many ways, this is his MO. Before a big event, he likes to drop a bombshell. Let's think back to the NATO summit last summer. Lots of people were saying, is he going to come in there? Is he going to quit NATO? What is he going to do? He came in there, he got on the plane and said, I'm still thinking. When he showed up, it was actually a very different event, and it actually went off very well. So we're going to have to wait and see how this week plays out. It's definitely going to be one of the most interesting Davoses you and I have been to, and we've been to a lot of them, ever.
I mean, what I'm surprised, surprised and not surprised, but it's like last week we were expecting the speech to be much more domestic on affordability, maybe going after some of the private equities, trying to do an interest rate cap for the banks so that people feel better back home. And then we had these tariffs over Greenland on Saturday that he's threatening with. Now, we don't know if it's legal. We don't know if he can do it. We don't know if he will go ahead with it. But again, the dynamics for European leaders here is very complicated.
Yeah, and look, we have 6 of the 7 G7 leaders in attendance. We have a lot of EU leaders who are coming. We're waiting to see, is he going to sit down with them? Is he going to have discussions over Greenland? When you look at his agenda, there's spots for meetings, but they haven't been confirmed yet. And of course, what has fallen to the back burner at the moment? Ukraine.
We're just expecting, of course, the Prime Minister of the UK, Keir Starmer, just speaking at Downing Street here. He is.
The values and the interests that guide us, even as circumstances change. The United Kingdom has a long history. Our values were not improvised. They were built patiently over time. And while we are pragmatic in how we pursue our interests, we are resolute in defending those values when it matters. So let me begin with the United States. The UK and the US are close allies and close partners. That relationship matters profoundly, not just to our security, but to the prosperity and the stability that people here depend upon. Under President Trump, as under previous presidents, we're determined to keep that relationship strong, constructive, and focused on results. And that approach is delivering. Through sustained engagement, we've seen significant US investment into the UK economy, running into hundreds of billions of pounds, supporting growth, skills, and jobs right across the country. Our cooperation on defense, nuclear capability, and intelligence remains as close and effective as anywhere in the world, keeping Britain safe in an increasingly dangerous environment. We've secured good trading terms in key sectors, including cars, steel, aerospace, and life sciences, protecting British jobs and manufacturers. That is why we take the approach that we do, because it delivers concrete outcomes in the national interest. I talk regularly to President Trump, and my team is in daily contact with all the key figures in his administration. These relationships matter. They deliver concrete outcomes in the national interest. Mature alliances are not about pretending differences don't exist. They are about addressing them directly, respectfully, and with a focus on results. On Greenland, the right way to approach an issue of this seriousness is through calm discussion between allies. And let's be clear, the security of Greenland matters. And it will matter more as climate change reshapes the Arctic, as sea routes open and strategic competition intensifies. The High North will require greater attention, greater investment, and stronger collective defence. The United States will be central to that effort, and the UK stands ready to contribute fully alongside our allies through NATO. But there is a principle here that cannot be set aside, because it goes to the heart of how stable and trusted international cooperation works. And so any decision about the future status of Greenland belongs to the people of Greenland and the Kingdom of Denmark alone. That right is fundamental, and we support it. Denmark is a close ally of the United Kingdom and of the United States, a proud NATO member that has stood shoulder to shoulder with us, including at real human cost in recent decades. Alliances endure because they're built on respect and partnership, not pressure. That is why I said the use of tariffs against allies is completely wrong. It is not the right way to resolve differences within an alliance. Nor is it helpful to frame efforts to strengthen Greenland's security as a justification for economic pressure. Such measures hurt British workers, British businesses, and the British economy. And that is why I've been so clear on this issue. A trade war is in no one's interest. And my job is always to act in the UK's national interest. That is why yesterday I spoke to President Trump, to European leaders, and to the Secretary General of NATO to find a solution rooted in partnership, facts, and mutual respect. Because that is how strong alliances protect shared interests. The same is true on other issues. In the Middle East, we welcome President Trump's focus on sustaining the ceasefire in Gaza and moving on to phase 2. We are open to participating constructively in such efforts. On Ukraine, I can be brief. We strongly support efforts to bring the killing to an end and secure a ceasefire as soon as possible. We recognise President Trump's role in pushing that process forward. And we will work closely with the United States, Ukraine, and our other allies to apply pressure where it belongs on Putin. Finally, let me say why all this matters so directly to people here at home. In today's world, geopolitics is not something that happens somewhere else. It shapes the cost of energy, the price of food, the security of jobs, and the stability that families rely on to plan their lives. When war drives up fuel prices, it's households who feel it first. When supply chains fracture, it's small businesses and working people who absorb the shock. And when instability grows, it's rarely those with the most power who pay the price. That is why this government's approach is rooted in a simple belief that we must use every tool of government domestic and international, to fight for the interests of ordinary people. At home, that means active government. It means taking responsibility for economic stability so that inflation is controlled, interest rates come down, and family budgets are protected. It means stepping in where markets fail, strengthening resilience, and ensuring that global shocks do not always land on the same people in the same places, the people least able to withstand them. That's why we've taken action to reduce energy bills, to freeze rail fares and prescription charges. But tackling the cost of living today also means engagement beyond our borders. It requires shaping the world around us, not retreating from it. It requires strong alliances, steady diplomacy, and rules that reduce uncertainty rather than amplify it. That is why our commitment to international law and to alliances founded on trust is not abstract or ideological. It's practical. It's about stability, predictability, and fairness. The conditions that keep prices down, jobs secure, and economies resilient. That is what active government looks like in an age of uncertainty. Steady at home, engaged abroad, and always focused on protecting the people that we serve. Britain is a pragmatic country. We look for agreement. We believe in partnership. We prefer solutions to slogans. And we will not indulge in commentary and gesture politics that harm the British people. But being pragmatic does not mean being passive. And partnership does not mean abandoning principle. That is why it's important to be clear about who we stand with, what we stand for, and where our interests lie.
Well, that was the UK Prime Minister Keir Starmer speaking there at Downing Street, calling for calm discussion between allies and Greenland. I have to say, we have been trying to get to delegations that will come here in Davos, and calibration is everything when dealing with some of the threats that Donald Trump has been putting in place. We also have some breaking news out of Japan. The Japanese Prime Minister, Takeshi, will call an election for February 8th. So again, that's something else that we need to watch for, and that's in just 2 to 3 weeks from now. Let's turn back to the world of banking. HSBC has just gone through its biggest restructuring in at least a decade, which has seen the bank retreat from its investment banking operations in Europe and the Americas in order to focus more on Asia and the Middle East. Well, joining us now is Michael Roberts, Chief Executive of HSBC Bank and Chief Executive of Corporate and Institutional Banking. Michael Roberts, thank you for joining us. I got to start by saying let's go back to banking, but at the same time, you also have to straddle and understand and navigate some of these geopolitical tensions between DC, between China, between DC and Europe. So what's the most complicated thing for you right now?
Probably the pace of change. As you said, every week there's something else that you have to factor into how we run the business. Look, we've been around for 160 years. We're pretty good at this. We've managed through several world wars. We've managed through lots of geopolitical tensions. So, and we're a very strong institution, very large balance sheet, lots of liquidity, fortress balance sheet as well. But I do think it's the pace of change and how we help our clients navigate through that pace of change.
Will tariffs be different in 2026 to 2025? It seems that, we were very worried about what tariffs would do. I'm sure a lot of clients were calling you up saying, how do I navigate this? They're changing the supply chains. Then we forgot about it, saying, okay, we're over the worst, and now they're back at the forefront.
Yeah, no, you're right. In fact, I was amazed at how resilient the supply chains were. I mean, all the Liberation Day chaos that came after, and I was, in fact, traveling then, and there was nothing but
calls.
Yeah, exactly right. And so now people, to your point, got used to it. I think the supply chains have been reordered a bit. I think, in fact, trade last year was up, which most people don't realize. It's $37 billion. It was up by $2.5 billion. or trillion, sorry. And you could see that what was happening, people just got used to it and accepted the fact there was going to be on average 15 to 70% tariffs. Now this is yet more surprise, more chaos, more unpredictability, I think, put into the system. This one, however, is not just a liberation day. This is obviously politically driven, and that's a little bit different.
What's the risk to HSBC and the wider banking sector?
Look, I think, again, the risk are really more for our clients. You know, it's not a big risk for us. I think we'll be able to get through it. It's really trying to help clients who, in particular European clients, who sell into the United States, because this is all levied against, of course, European countries. And that's going to be challenging for them. You know, they've accepted the 15% tariff, although, of course, those negotiations seem to be stalled. And then on top of this, whether it's 10 or up to 25, it's quite a lot. And so for them, most of whom have very sizable operations in the U.S., that tends to be the largest operations outside of the home market, sometimes even more than the home market. Think of the Swiss companies here. So I think it's going to be quite a challenge. And so we'll try to help them figure that out. It stresses cash flow. It stresses just revenue, you know, in a time where, you know, debt is rising in most corporations around the world. That could be problematic as well.
Michael, HSBC shares now trading around all-time highs.
Yeah, we like that.
How higher can they go? How much
I hope a lot higher. So, no, we're very pleased with the progression in the share price, and I think it reflects, as you mentioned earlier, the transformation that we went through. It's really paying the dividends, we thought. As George has said many times, you know, we're going to hit the numbers we've told the street, and they could see that not only is this an efficiency play, which it was, it really is making HSBC it's a better organization, more agile, more customer-centric, less complex, which was always really, I think, the challenge for HSBC. And so we hope, I don't know where it's going to go. I hope investors see the value and the benefits, and it keeps going up. I think there's more buy than sells, which we love to see. So we hope it goes much higher.
I mean, you must have celebrated in December. I think you became a 200 billion pound bank.
We
right?
did. And
is
we're
300 billion next?
I'm hoping so, yeah. And I think that's the trajectory. I mean, if you could see, to your point, from 200 to where we are today, 266, 270, to get to 300 is so certainly within reach. And that's where we want to be. We are one of the most important global banks in the world. We operate in 55 countries, $3.3 trillion worth of balance sheet. That really, in our opinion, given where we think we can generate the profit, really deserves a much higher rating.
Is that it for restructuring?
I think we've gone through much of it. You know, there's some trailing issues we're going through, which is always the case, but the bulk of it, yes. And the CIB, which I manage, is the largest part of that restructuring. And I could say we've gone through a very, very quick organizational change for such a big organization. That was the focus. Very intentionally did we want to go through a quick series of changes because we did not want to drag it on. Bad for clients, bad for employees, bad for everyone. And so the bulk of that is certainly done.
I was going to ask actually about morale. So is it better just to get done quickly so that then people feel better? And so how's morale right now?
Look, I think morale has rebounded. And I think George has said, you know, that toughest thing is to say goodbye to some very long time colleagues and friends. That's been done. That was done early in the process. So we can really safely say we're looking really to the future. And I think that is what builds better morale when people know the transformation's over. But I think they're very excited, actually. They're excited about the pace we've used to change the organization. They're excited about the direction, excited about the stock price. They're excited about some of the things we're doing, which really, I think, paint a very positive picture. But they don't like the uncertainty. And so that's why we went so quickly, is to get rid of that uncertainty.
Michael, talk to me a little bit. I mean, here we have a lot of U.S. tech firms,
right,
and we talk a lot about AI. Talk to me about quantum tech and how you're expecting that to transform HSBC.
Yeah, you know, we have a joint venture with, or a joint initiative with IBM, really to develop quantum computing, which we did sort of as initially to look at how we could match buyers and sellers in the bond market,
right,
and to give better accuracy and how the predictability on where we should actually try to sell our bonds. It actually did improve it. Now, so it's just a first initiative, something that we think has value, because I do think quantum computing will become more and more a part of how banks trade. It's a big part of how we manage our cybersecurity, by the way. So it's already embedded in our cybersecurity, but now we're taking to more of a revenue generation type of activity. It's a first, so I don't want to get too excited about it. We have more to do. but we were very excited with the results, and IBM's been a great partner in that as well.
Michael, I mean, if this is successful, like how large could it be? Like how much of a transformation could this actually be for HSBC and the sector?
Yeah, I mean, if you think, without doubt, most trading will be on a tokenized basis, it will be on an AI basis. You're just adding a layer of quantum computing to make it that much more efficient. So trading of all asset classes, I mean, none will be immune. It's going to go through a fundamental change, and I think probably after AI and after tokenization, you'll see quantum come.
What are you expecting from AI?
AI will be quite significant. So I think you'll see, we do a lot of algorithmic trading already. Yeah. I think, you'll have agents to agents start doing trading in the not too distant future. I think you'll look at different asset classes. Again, none are immune from that. And I do think it will speed up trading. I think it will make it more accurate. I think it will quickly become the way that most firms trade. And so we're in the process, like I'm sure many institutions, are really embedding that into our trading.
Yeah, our staff asks about it because it feels like when you speak to employees, they're worried that they're here.
Yeah.
I don't know how you manage that.
I think it's a bit of both. Yeah, and we need to show that it's not about, and it's, banks are built on procedures. I mean, they're perfect, user forward. Free. I think it'll lead to massive layoffs. I don't think it'll meet for instance, our bankers are too much time on administrative details. Right. If we can free up that time, I could put them more to work going to see clients, really bringing value to those clients.
And Michael, for the next couple of years, I mean, do you see, these are huge investments, right?
Yeah.
So you have to upgrade systems, change systems. Mm-hmm. Does that mean that you'll hire a little bit less, that there's less young staff coming in, until the cost adjusts?
I think that's a great question. And that's one that I personally am very focused on. We are an apprenticeship culture. So you have to bring in younger people to give them the tools, the experience to do well. So I think there's going to be a lot of balance in between then. Yes, you could take one road to say we're going to just maximize efficiencies, not hire anyone, save a bunch of money, and plow it back in AI. Certainly there will be some of that, but at the same time, we really need to focus on making sure we bring in the young people to build for the future. And so there's going to be a lot of balance between the two.
Michael, thank you so much for joining us. Michael Roberts there, the Chief Executive of HSBC Bank and Chief Executive of Corporate and Institutional Banking. Now, that's it from me. Coming up, Jumana Brzezinski will be here to discuss the protests in Denmark and Greenland over President Trump's bid to take control of the island, with the British Prime Minister, of course, who was just speaking from Downing Street on the European response. This is Bloomberg.
Is fragile. There is a ceasefire. We need to move to phase 2. We mustn't lose sight of that. In Ukraine, we've been striving for a just and lasting peace for a long time now. We're 4 years into that.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion
per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back to the Pulse Live from Davos. I'm Joanna Bersacci, filling in for Francine Lacroix. President Trump's visit to the World Economic Forum in Switzerland this week is set to be nothing short of dramatic, with the agenda likely to be overshadowed by a new tariff threat sparked by his pursuit of Greenland. Shortly, we'll go out to the Copenhagen bureau chief. But first, let's hear from Investcorp's executive chairman, Mohamed El-Ardi, about global uncertainty and finding value in the U.S.
Obviously, uncertainty is there, but I think we look at value everywhere, and there is value everywhere in pockets. In the United States, for instance, I think what's going on in terms of the stimulus, in terms of the focus on technology and AI, some of the things that made tax codes permanent is really helpful for business, but also the approach about looking at affordability. All these things are to make good business and investment environment. So basically, we see value everywhere in pockets.
Do you think private capital is going to play even more of a stabilizing force over the next couple of years as countries have to deal with the rise of protectionism and look inwards?
I believe so. I mean, as you know, Investcorp has always really been a bridge for private capital from the Gulf outside and from outside the Gulf inside. And it's a patient, it's, I think, capital. It's something that really reduces volatility, especially in times when you do need patience with capital. You do need thoughtful processes in ensuring that you invest through crises and cycles.
Yeah, so you're a homegrown Middle East investment fund, and I'm curious to hear how you see the opportunity set right now in the Gulf. I mean, you have countries like Kuwait also looking to open up as well. I mean, how are you seeing the opportunity set specifically in the Gulf? You've been there a really long time.
So we look at the Gulf as really an ecosystem for us. It is definitely a very compelling long-term investment market in this global economy. I mean, you have clear policies, you have sovereign balance sheet that is really strong, you have capital, you have huge economic transformation agenda.
That was the Investcorp executive chairman, Mohamed El-Ardi, speaking to me earlier. Now, thousands of people have rallied in Denmark's capital over the weekend, protesting Trump's aggressive stance towards Greenland, shaking the foundations of the NATO alliance after he pledged a barrage of new tariffs over his ambitions for the island. Let's bring in Bloomberg's Copenhagen bureau chief, Sarah Sjolen. Keeping a close eye also on the reaction from Europe, because just a short while ago we were playing some live images of the UK Prime Minister Keir Starmer giving an emergency press briefing over the situation in Greenland. Obviously, that has been super topical over the course of the weekend. But now we are seeing demonstrations being held in both Copenhagen and in Nuuk. What has been the reaction of the people on the ground?
Well, it's just been the last few weeks has just been shock and anger, upset, bewilderment. A lot of people don't really understand what all this is good for them. They're uncertain whether we can find an end to this stalemate. Now we have the tariffs. It just feels like this Kafka nightmare where it never really ends. I went to the protest on Saturday in Copenhagen, and there were more than 20,000 people out there to protest against the U.S. And what really struck me when I talked to the local Greenlanders and hearing the speeches from stage is that people are actually really scared. Maybe not so much here on the ground in Denmark, but they were concerned for the relatives in Greenland. The Greenlanders are scared. A lot of them have trouble sleeping. Some of them are being flown to Denmark for psychological help. It's a country that's already really have a difficult history, and now they feel like the boundaries have really been overstepped again.
When we talk about the U.S. military presence in Greenland, what are we seeing actually in terms of boots on the ground there? German soldiers have left, but Canada are considering sending their own now?
Yeah, Canada is considering sending some soldiers to Greenland. They're quite close by, there's a proximity, but it's quite significant if we're going Canada to send some troops there as well, because that would be the first non-European country to really show support here. The Greenlanders really, really welcome all this NATO presence, but they will, of course, they like to see more. They want to feel more safe.
Sarah, thank you so much. Sarah Solin, Bloomberg's Copenhagen Bureau Chief, right at the heart of it, a major story that we've been following over the course of the weekend and this morning. Now, former Bank of Portugal Governor Mario Centeno has told us monetary policy should act as a stabilizer amid heightened tensions between the EU and the US. Centeno, who is a candidate for the European Central Bank's vice presidency, spoke with Anna Edwards and Tom McKenzie on the opening trade.
I think European Union institutions will increasingly be called upon to act as a stabilizing actor. And this very much applies to the European Central Bank and to monetary policy. It would be great if Europe can continue this coordination of policies that we achieved in recent years, because really the challenges are very, very big.
Okay, so monetary policy should act as a stabilizer, you think, Mario. What if European politics dictates that the Commission responds with retaliatory tariffs? How should monetary policy respond then?
Well, you know, we have a mandate, which is price stability. Some of these policies and the shocks that we are facing, they have an impact on prices. So the best thing that could happen for all of us would be to each dimension of economic policy to do exactly what is expected for it to do. So monetary policy should continue to look for price stability. This is our mandate. But we do understand that it's very important for us to keep that in mind, that the coordination of policies helped us a lot to go through the COVID and inflation crisis. And these challenges that we face today are not smaller. So we need to, expect that this, how I put it, this stabilization anchoring from policy can really be on the table.
That was Mario Centeno, Portugal's former central bank governor, speaking to us earlier. All right, let's take you back to Downing Street now, where the UK Prime Minister Keir Starmer is still speaking on Europe's response to Donald Trump's threats of tariffs over Greenland.
Well, Andy, I don't agree with that assessment, because taking the approach we've taken has yielded hundreds of billions of pounds of inward investment into the United Kingdom. That's hugely important for our economy and for jobs and businesses and the economy more generally. We are involved on a daily basis when it comes to security, defence and intelligence sharing, daily, 24/7, in relation to the interaction on intelligence between the US and the UK is the closest relationship of any two countries in the world. And that keeps us safe in ways I can't explain to you. But I can say very clearly it keeps us safe and is vital to every single person who lives in this country. And of course, before we got to the better trading arrangements on cars, on pharmaceuticals, etc., many people were urging me not to take the approach that we did, but we did take the approach we did, and we got better trading terms. And that's why I'm taking the approach I am to this situation, to ensure that we focus on what's in our national interest. Thank you, Andy. And I've got Peter Walker from The Guardian.
Thank you.
Peter.
It's been widely reported this morning that the Norwegian Prime Minister has received a message from President Trump, basically saying the President is peeved because he didn't get the Nobel Peace Prize. Whilst I'm sure everyone watching this will fully understand why there is a need for the UK and US to kind of keep collaboration and links so close, Can you understand why some voters look at what President Trump does and says and think, are we actually serious? Can we actually get anything from him? And if I may, I know that no policy has been announced yet, but from a personal point of view, do you think it would be a good idea for social media use to be restricted for younger people?
Yeah, just I completely understand why what President Trump said about tariffs over the weekend has been so badly received in this country. I completely understand that. And I think that's understandable. And it's important that that is met with me setting out, as Prime Minister of the United Kingdom, what our principles and values are in response to that. And not pretending that we don't have differences. Because strong, respectful alliance.
Well, you're listening to part of the press conference, an emergency press conference the UK Prime Minister Keir Starmer has been holding this morning to talk about some of the new threats to Europe, to European allies, and obviously the threats over Greenland. But today's big take is called Survival of the Richest, Trump's Chaos Sets Off Rush to Davos. It's co-written by our chief Wall Street correspondent, Srinath Rajan, who joins us now. You know what's interesting about all of this is despite the setup going into this week and the fact that there is going to be a big focus on the U.S. delegation, it is also a record number of people who are showing up to Davos this year. Over 3,000 world leaders. I think 6 out of the G7 leaders are also showing. Huge number of executives as well. And I guess partially some of that is because they do want to be in President Trump's good books.
Well, you can be rest assured that chaos always prompts interest, but it's fair to say that even before the start of the year and even before some of the most disruptive events that we've already seen in January, we had a lot of people who had signed up to come here this year because President Donald Trump had signaled very early on that he will be present in Davos in person for the first time in 6 years. And that certainly meant that a lot of CEOs signed up to come, a lot of heads of state signed up to come, because what we know is no one can predict the nature and the action of the step being taken by the US administration, but what they want to do is make sure that they're part of the economy of access, because that seems to be super critical. We've seen that in the first year of Trump 2.0, and we know that there are still 3 more years of this to go.
Yeah, it's sort of an evolution of sorts of the relationship between the executive community and the president. You cover Wall Street executives very closely, and I think it's interesting that in the past couple of weeks also, the industry has rallied behind the independence of the central bank. I mean, to what extent do you think that could pose somewhat of a barrier between President Trump and Wall Street in the months ahead? Or is it something that actually Wall Street are willing to look past at this point?
I take the flip side of that. I would say minimal barrier, because the nature of the comments has been very moderated, has been very controlled. No one's really going out and ringing the big alarm bells. Yes, when they're asked about it, they're obviously saying that they believe in the independence of the Fed.
Yeah.
But if you actually think about the actions, think about what's happening back in the US, the fact that Fed Chair Jerome Powell has been served with a subpoena, that there is potential legal trouble that he's in that could leave him in real deep trouble, and yet the nature of the comments has been more controlled, which almost tells you that corporate America has realized that there is no upside in going up against President Donald Trump in a loud fashion. They will make their noises and they will express their policy disagreements on narrow issues, but as a broad-based corporate bloc, they're not going to rise together as one to combat this administration or even express their disapproval of actions that they in their bones truly believe to be wrong.
Yeah. Well, I highly recommend to everyone to take a look at today's big take. It's on the terminal, as Srinath Rajan, Bloomberg's chief Wall Street correspondent, co-authored the piece. Well, coming up tomorrow on The Pulse, Francine will be joined by JP Morgan's Filippo Gori, the Nigerian finance minister, and the CEOs of Merck and Novartis. And you can keep up to date with everything going on here in Davos with Bloomberg's Economics Daily Newsletter. Scan the QR code to subscribe and get on-the-ground coverage of the World Economic Forum direct to your inbox. But that rounds up this edition of The Pulse. Up next, Bloomberg Brief. This is Bloomberg, live from Davos.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
What some of these generative AI models look like they're going to do is they're going to reduce the cost of producing content to basically zero. So that will be a multiplier effect on the things that we're already seeing, which is that there's more people producing more content and reaching more people. And there's a lot of good and bad that comes downstream from that.
I don't know if you can break down what the average person is seeing right now in terms of stuff that's AI generated versus, maybe more traditional human generated, but what's that going to look like in a year or in 5 years?
There's actually a lot of hybrid content, and too often we talk about synthetic content and organic content and never the two shall meet, but there's a lot of content where AI is part of the workflow, right? Like you might not even know it. It might be whatever app you're using to do color correction might be using models to do so. Stamp tool in Photoshop in the old days to get rid of a pimple, those types of things. But that line is going to be more and more blurred. So it's going to be a little bit less like what is organic content and what is AI synthetic content and what the percentages are. I think there's going to be actually more in the middle than pure synthetic content for a while. But you will also see experiences that are purely AI, right? You see this in the last 2 weeks with Vibes in the Meta AI app and with Sora 2 from OpenAI. So I think you're going to see both.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Every weekday from 3 to 5 Eastern.
Only on Bloomberg. Context changes everything.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg.
Welcome to Bloomberg Markets. It is 10 a.m. in London, 5 a.m. in New York. US markets are, of course, closed today for the Martin Luther King holiday. I'm Anna Edwards with this special edition of Bloomberg Markets live from London. Here are your top stories. Coming up, Trump reignites a Europe trade war over Greenland as the EU weighs retaliatory measures. China's growth flashes warning signals as consumers pull back and deflation deepens. And we're live from the World Economic Forum in Davos with the CEO of the Qatar Investment Authority. We'll discuss sovereign wealth, the world economy, and the biggest risks shaping markets. Thinking about how those risks are shaping markets, let's have a look at how European equity markets are coping today, 2 hours into their trading session, and very much on the back foot as a result of President Trump's threats around trade tariffs. The Stocks Europe 600 then down by 1.3%. The CAC 40 down 1.5%. A lot of luxury names, a lot of auto names in negative territory as a result of the tariff fears. We're also watching Scandinavian stocks in particular being hit pretty hard. Very few areas of green when it comes to equities. Let's have a look at fixed income markets. And through the Asia session, we certainly did not see the fixed income markets acting as a haven. We saw yields going higher in Japan. That's a different political story, one we'll deal with as we go through this week, no doubt. But this is a picture for European bond markets. Of course, we don't have US bond markets trading today. We won't do because of the holiday. The UK 10-year yield pretty unmoved, as you can see. We are seeing some buying of the French and the German bond markets, but not a huge amount given the risk-off we're seeing in stocks. You might have expected to see more. Let's have a look at some commodities for you. We've got new highs on gold, new highs on silver. All of this very much illustrative of the doubts around fiat currencies, the flight into safe havens on days such as today. We do see the dollar on the back foot, and we see the euro showing some strength, up by 0.2%. But in precious metals, that's what we have right now. Copper is interesting, up by 0.6%. Actually quite a mixed picture when it comes to some of those metals. We have a mixed picture coming out of the Chinese growth story, and that's sending copper and some of the other metals in different directions, plus the dollar effect is having an impact in some cases. Let us get some of the stocks that we are focused on this morning. Here's Chloe Melly with a briefing. Chloe, good morning.
Good morning, Anna. Bayer is in the green today because the U.S. Supreme Court agreed to review its appeal related to lawsuits against its Roundup weed killer, which has been accused of causing cancer. So this is really positive for the company because this would mean that some of thousands of those cases could be thrown out because they could lose their legal footing, and so that means less risk of settlement for Bayer, and therefore this is really driving the shares this morning. We are up more than 6%. Moving on to automakers, which are not having as good of a day today. They are all in the red because of this latest threat on tariffs from Trump. The tensions between the US and the EU are really escalating over Greenland, and car makers, which are a sector that is particularly exposed to tariffs to global trade, are really caught in the crossfire, and we are seeing BMW in particular very, very weak this morning. And finally, LVMH is also feeling some of that tariff pain and also is feeling the Morgan Stanley downgrade, which said that there's only so much further those shares can go for LVMH, despite the industry being actually in a really good position this year.
Chloe, thank you. Chloe Melly with a briefing on some of those stocks that are on the move. Let's focus on our top story then. The EU is warning it's ready to strike back. European leaders weighing tariffs on 93 billion euros of US goods if President Trump follows through on new trade threats that, of course, he announced over the weekend. The UK Prime Minister Keir Starmer addressed the situation at Downing Street earlier.
Alliances endure because they're built on respect and partnership, not pressure. That is why I said the use of tariffs against allies is completely wrong. It is not the right way to resolve differences within an alliance.
Let's get to Bloomberg TV's chief European correspondent, Oliver Crook, who joins us now in Brussels. Ollie, a continuation of the messaging from Keir Starmer there, the UK Prime Minister. He said at the weekend that it was wrong what what President Trump had announced he was going to do around tariffs. We've heard some pretty vocal pushback from other European leaders as well.
Yeah, that's really the consensus here in Europe, that this is basically this tariff threat now being used, not just as it has been used in the past to basically rebalance what Trump has called, unfair trading relationships with the European Union, where you can see very calculably, very clearly a sort of imbalance of goods, right? This surplus that the EU runs with the United States. And I think that for that reason, those claims were seen as, in some way more legitimate from the European Union, even if they deviated from global norms in order to use tariffs to try to rectify that. Now, this is using the tariffs in order to basically advance a geopolitical aim to violate the sovereignty of one of the European nations, that in Denmark, that obviously is sovereign over Greenland, and that is seen widely as completely inappropriate by European leaders and may in fact be a red line. That's what the Germans have called it, that this is now a red line, where the word blackmail has come out from a number of different European leaders, saying that the Americans are basically just blackmailing the Europeans in order to advance the political aim. The question now is, where do we go from here? For the European leaders, what they need to gauge is how much risk appetite they have, how much willingness they have to get further enmeshed in a potentially escalation with the United States. They basically will hold off on taking any retaliatory action until February the 4th to see if those tariffs in fact come in. But if those tariffs come in, it's hard to imagine a world in which the Europeans will not raise tariffs of their own and start to target some of those U.S. goods and potentially use the anti-coercion instrument, which would give them more sweeping powers to potentially target American tech companies. So that is the very difficult balance that the Europeans need to now walk. They're hoping to get a diplomatic breakthrough with President Trump while he's in Europe, while he is in Davos, though it's very difficult, I think, at this stage to see what the possible off-ramp is. So for the Europeans, now they're going to be assembled here in Brussels on Thursday for an emergency meeting in order to discuss the path forward. They're going to have to weigh the cost-benefit, the economic cost, of course, but of course, Anna, there's huge implications for the NATO alliance. Also, the fear that Ukraine could be used as a bargaining chip, that potentially the United States could withhold military hardware or intelligence support. All of these things go into this calculus for European leaders now faced with another crisis brought by the Trump administration.
Yes, and President Trump has said that this is because of different stances on Greenland and possibly even a misunderstanding about what troops from Europe were sent to Greenland to do, Ollie. But he's also, over the last couple of days, it's become clear that perhaps the Nobel Peace Prize and the fact he didn't win it has had some bearing on his thinking.
Yeah, so listen, Anna, we'll add that to the list of many things. There's initially this sort of idea that is about security, about the Arctic, and that the United States doesn't feel really confident with anybody's ability to secure Greenland apart from themselves. There's been the argument about raw materials. There is the argument potentially about Trump's legacy and wanting to expand the U.S. landmass. Add to that what we got over the weekend, this very bizarre letter that was addressed to the Norwegian Prime Minister. And I'll just quote from it directly. Dear Jonas, this is in reference to Jonas Gahr Støre, the Prime Minister of Norway. Considering your country decided not to give me the Nobel Peace Prize for having stopped 8 wars plus, I no longer feel an obligation to think purely of peace, although it will always be predominant, but can now think about what is good and proper for the United States of America. So if this is in fact the actual reason that Trump is pursuing Denmark, that is not going to be seen as legitimate, of course, by any sort of European nation. It is actually quite terrifying, I think, for the Europeans to consider.
Ollie, thank you very much. Thanks for the update. Bloomberg's Oliver Crook with the latest on these developments around trade. Now, as tariffs shake global trade, let's speak to Sam Linton-Brown of BNP Paribas, who'll break down what it means for currencies, rates, market resilience, and all the rest. Sam, very good to speak to you. Thank you for coming to join us. Let me start with stocks and what we're seeing here. We've got European stocks on the back foot. US futures actually looking a little worse than they did a couple of hours ago, worsening a little. Will a lot depend at whether these losses are sustained? Will a lot depend on Europe's decision about how it plans to retaliate?
It will, but zooming out for a moment on the equity market, I think the context in which this news flow has arrived is important. The market's had a very strong run. What we've seen is that expectations this year for growth have been continually revised up. The market's already bullish. And the market's also pricing in dovish central banks relative to how strong those growth expectations are. As a result, equity positioning, according to our proprietary quantitative positioning metrics that we run at BNP Paribas, has shifted from a little bit underweight to now overweight, which means that even prior to any of this news flow we've had today, we had advocated that for both equities and credit, it makes sense to shift to a tactically neutral stance, having previously been bullish. So I think the reaction that we've seen in the market today, this risk-off, needs to be seen in the context of a market that was already quite sensitive to any negative news.
Okay, so equities was sort of prone to this, I suppose, then, Sam, from your analysis, given the positioning going into this news flow. What about FX markets? We've got the euro actually strengthening on this over the weekend. Lots of people were talking about whether the euro would go up or down as a result of this. Well, the euro gains and the dollar falls, as if this is seen as a bit more of an own goal from an FX perspective. What would you expect to develop there?
The market's very focused on what happened in the first half of last year, where we saw a big increase in uncertainty stemming from US policy on trade, more rhetoric as well around the Fed and potential independence concerns that were building in the market. And that H1 2025 paradigm, as we'll remember, saw a big weakening in the dollar. And so the market's got that in mind, that when we see these types of resurgence in foreign policy uncertainty, that the dollar can be vulnerable. There's 2 points I'd make in terms of what's going to determine euro-dollar near term. I'd say the first is how European countries respond. Europe, during times of potential crises, in some respects, if we look back, has actually benefited because it can act as a catalyst for either further integration or changes in fiscal policy that are viewed by the market as currency supportive. So, for example, if we were to see more steps towards EU issuance, further integration, and or more defense spending at a national level, the market would see that as euro bullish. The second point I'll mention is currency hedging. This was a super important driver of dollar weakness in the first half of 2025, since the initial rush to hedge away dollar currency exposure on overweight US asset holdings from European investors passed in the first half of 2025. That flow has really slowed down. And what's going to be super key for the outlook for euro-dollar over the next few months is if we see the latest geopolitical tensions result in that flow resuming. We're bullish on euro-dollar overall. We have a 120 target for this year.
Okay, which does suggest a little upside. Are you surprised that we're not seeing more of a flight into European bonds, Sam, or would that not be what you'd expect to see? We've seen a little, but it's not. Given the scale of the retreat in stocks, might you expect to see more?
I think there's two factors here, one short-term and one more structural. The short-term factor is Japan. You mentioned it in your opening remarks. We've had a huge move higher and steeper in the Japanese bond and swap curve today as the market's beginning to price in even looser fiscal policy in Japan. So that acts as a counterbalancing force to the bullish duration news we've had today for European fixed income markets. The second factor is structural, and that's supply. Supply globally of bonds, net redemptions, is going to remain very, very high this year. It's going to fall slightly across G4 compared to where we were in 2025, but 2025 was the highest ever, and that fall is only going to be slight. And that assumes we see no additional US fiscal stimulus before the midterms. If we do, it's possible that net bond supply in sovereign markets across G4 will actually be higher than it was last year. If that is accompanied by what is a big increase in US corporate bond issuance related to IG issuance, investment grade issuance because of hyperscaler debt issuance, it means the market has to digest a lot of bonds, which means that generally speaking, while you can have short-term risk aversion-driven rallies in core duration in Europe, like the German government bond market, overall we think yields are going to head higher. We have a 3.1% target for 10-year Germany.
Yes, and it strikes me that we're without the US, aren't we, today, because it is this public holiday. And so perhaps we have to wait until tomorrow to get a full sense of how investors are going to respond to some of these news items. Sam, thank you very much. Thanks for joining us. Sam Linton-Brown of BNP Paribas Markets. Now to other top stories trending on the terminal this morning. Japan's Prime Minister Sanae Takaichi says she will call a lower house election for February the 8th and will dissolve Parliament on January 23rd. Takaichi plans to campaign on a temporary cut to the sales tax to zero on food for 2 years, a policy move that has resonated with the public in the last 2 national votes. Former UK Prime Minister Tony Blair has distanced himself from President Trump's demand that countries pay $1 billion for permanent membership of the Board of Peace. Blair declined to endorse the request for the funds, which is part of a draft charter for the nascent organisation. And at least 39 people have died in a train collision in southern Spain, and dozens more have been injured in the country's worst rail crash in more than a decade. Carriages on the Madrid-bound train derailed and crossed over the opposite tracks, colliding with an oncoming train in Adumas on Sunday evening. The Spanish Prime Minister Pedro Sanchez has cancelled his planned Davos trip in the wake of that crash. And the EU braces for a trade showdown with the United States as Washington awaits a key Supreme Court decision on presidential tariff powers this week. We'll get an update on what to watch there. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Welcome back. This is a special edition of Bloomberg Markets because, of course, it's a US public holiday today. Let's focus in on the data we've had out of China overnight. China's economy lost more momentum last quarter, even as it met the government's target in 2025. It's the slowest pace since the reopening from COVID lockdowns in late 2022. Joining us now from Hong Kong is Bloomberg's Alan Wong. Alan, great to have you with us. It seemed that some of the data here, looking particularly at December, beat expectations. Some of it came in a little bit weaker than expectations, and it was met with not a particularly huge response from markets. What was the big takeaway for you?
If you will, the big takeaway is that China achieved its mission, its target of 5% growth for 2025. But the more important question is, what does the outlook look going forward? And then the data released today spells some trouble for the Chinese economy going ahead. A nominal GDP grew only 4% year over year, which is a very low number for China at this stage of its development. It means that people's wages aren't growing very fast and that deflation remains a very entrenched problem. In terms of the economy, domestically speaking, the spending of consumers remains a big hole in the economy. And in the last year, it was exports and industrial productions that contributed to the bulk of China's growth. And in the coming year, if there's more trade friction, there's more pushback against China's rising exports globally, then China's export momentum may not last. And as a result, that economy may not grow as much as China would hope.
Alan, thank you very much for the briefing. So a lot of focus then on the domestic story within China as we go through this year. Alan Wong joining us there with the latest on the Chinese data. Let's go back to our top story. President Trump escalating the Greenland standoff, announcing new tariffs on 8 European allies that have backed Denmark's stance. Meanwhile, the EU is preparing its own retaliatory measures. Here with the latest is Brendan Murray, our Bloomberg trade czar, of course. Brendan, so much to discuss here. I'll start with whether you think that do we know whether President Trump's tariff threat will actually come to pass? I mean, is it going to be something he plans to do under IEEPA? We're waiting for the Supreme Court to rule on that. Is it even possible to put tariffs on specific European countries that are under the EU's trade umbrella? What's your thinking there?
Yeah, those are all the questions that they're asking in Brussels and in Washington right now. The president didn't give many details about how these tariffs would be implemented. And of course, he threatened tariffs on Iran's trading partners a week ago, the 25% tariff, and those have not been implemented or any other details. So what we're seeing is we thought a lot of these trade disruptions from the White House were in the rearview mirror. They're not. And the president gave everyone another reminder over the weekend that he believes he has the authority to, at a moment's notice, or with a short window like the less than 2 weeks that he said these latest tariffs would be implemented by could come at any moment. And he views the tariff tool that he has for the past year as something that he can use to accomplish geopolitical goals like controlling Greenland or bringing a regime change in Iran or other things that we saw him do with Venezuela last year, putting high tariffs on Indian exports to the U.S. So the president is kind of doubling down on this, and he knows that the Supreme Court is going to rule on this authority any day now. And so all of these foreign policy issues are getting wrapped up in this tariff authority that he's used.
Okay, and what are we watching for when it comes to the European response, Brendan? We know that the Europeans worked on using some of the tools at their disposal to draw up a list of companies they could put tariffs on from the United States. They did that last year. They then never actually put it into place because a trade deal was done. Well, that trade deal now is paused as a result of these developments over the weekend. So how would we expect Europe to respond?
Well, Europe seems to be hoping that diplomacy can still work, but they're getting to the end of their belief that it can. We heard from UK Prime Minister Keir Starmer, who said that he wants to give diplomacy a longer time to play out, but he also said that this was a completely wrong way for President Trump to go about the issues that he wants to achieve in Greenland. So we're seeing the European unity tested once again. The countries that President Trump targeted are export exposed countries like Germany and France and Sweden, and so this is really going to test whether the Europeans will cave to President Trump like they did last year in Scotland, or whether they will stand up and use some of these these tougher tools that they have adopted to use against a country like China or the U.S. now, that they would see as applying economic coercion to their industries and their consumers.
It was interesting that Scott Bessent, when given the opportunity to sort of dial up or dial down the tension on this story, Brendan, wasn't doing necessarily what some in the market have become accustomed to him doing, which is to add a more sort of market-friendly take on what the Trump administration is doing. It didn't seem as if that was his plan. He was saying that President Trump is using his strategic leverage to get what he wants. I suppose for those watching the trade agenda, that will have been of interest.
Yeah, exactly. Well, he also said that, the Europeans will come around. So I think he thinks that, what we're hearing is the shock and the exasperation from the European leaders at the moment. But ultimately, President Trump and his administration's pressure will bring them to heel. And that, at least from Secretary Bessent's perspective, that's how he sees this playing out. We heard Kevin Hassett, the National Economic Council director, yesterday say this is really kind of textbook art of the deal stuff from Trump. So at least you have Hassett, again, he's a contender for the Federal Reserve Chairman's position, saying this is really a negotiating tactic, and we'll see how it plays out. But this is the way the president does his diplomacy, and the Europeans will have to contend with that.
Yes, very much evident that President Trump is still very much drawing on his experience in real estate in the way he talks about this, saying you really need title, suggesting that ownership of this territory is what really matters. What are you going to be watching for in terms of the Davos news flow, Brendan? The President Trump will be there, of course, and trade tensions kicking off the week with a great deal of focus on him, on his arrival, and all that he does there at Davos.
I mean, from my perspective, it's all eyes on 10 a.m. Washington time tomorrow, 4 p.m. in Davos, and whether the Supreme Court rules on these IEEPA tariffs then, or either tomorrow or Wednesday. And can you imagine, if that announcement, those headlines cross the news wire while President Trump is attending the gathering, you could expect some fireworks in Switzerland if that's the case. So we'll see. We don't know for sure what the Supreme Court's agenda will hold in terms of rulings tomorrow. They don't tell anybody in advance. But we'll be ready, and a lot of people think that could swing at least partially against Trump's IEEPA tariffs.
Yes, I mean, we've 2 times, I think, in the last couple of weeks, Brendan, I've been braced to hear from the Supreme Court on this subject, and it hasn't happened. But as you say, they never promised when they will give us their conclusions. What's the latest thinking on which way they will decide to go, in favor of President Trump or against, and whether they will weigh in on the thorny issue of how refunds are made and to whom?
Yeah, exactly. So the betting markets still see a fairly high odds that Trump will lose this. But the longer it goes that we don't get a decision, the more people are going to second guess whether we're going to get more opinions from the justices, and whether this isn't going to be such a clear-cut loss for President Trump. So the longer we go, and if we don't get anything to Tuesday or Wednesday of this week, it could be the end of February before the next opportunity comes along. So I think you could see those odds that President Trump will lose. It could go down quite a bit if we don't get anything this week. The thinking on the refunds is that the Supreme Court won't really get into that, and that they'll leave that to a lower court and leave it to the sort of bureaucracy in Washington to figure that out at the Treasury Department, to figure out how to send those something like $150 billion worth of refunds back to American importers.
Brendan, thank you very much. Bloomberg's Brendan Murray covering all things trade for us and feeding into the World Economic Forum. Of course, as he said, his focus this week might be elsewhere, might be on the Supreme Court. We will focus on that. We will also focus on everything that's taking place at the World Economic Forum in Davos, Switzerland, where Francine Lacroix is moderating currently a panel with the Qatar Investment Authority, the CEO of that, Mohammed Al Sawaidi. And let's just listen into that.
Fund commitments. And it's an ongoing exercise. of thinking about growth. Now, His Highness have elaborated a couple of years ago that a lot of the additional reserves that will come from the state, from the increase in the LNG production, will be rooted for the future generations. So we needed to live to the game. We wanted to focus more on sharpening the edges around QIA, being mindful as a long-term investor, increasing the level of specialization within the institution. We've been doing a lot of things throughout the years to be ready for it. And we're ready. And I think we're very ready despite all the changes and challenges that happens in the markets every day.
Could we see the fund do anything substantially different because of the extra capital?
I don't think substantially different. It's a large organization already. And those incremental changes will refine our conviction on how we address markets. Fundamentally different, no. But the scale and size will increase naturally with time. But we've been thinking and visiting our philosophy as an organization a lot over the past 12 months and thinking what would be the right factors that enable us to grow systematically and be top performer and world-class investor in the world.
Your Excellency, you've announced a $500 billion investment pledge to the U.S. over the next decade. How's that going so far?
Going very strong. When you think of the U.S., it is the largest economy in the world, with close to 30% of the global GDP, but it is about 60% of the investable universe. So you cannot be a long-term investor not having significant exposure to the United States. At the same point of time, the U.S. enjoys strong positioning, a lot of the leading sectors in the world. If you think of technology, if you think about industrial activities, if you think about defense, if you think, go on, they have strong market positioning, the U.S. institutions. At the same point of time, it's very deep market. It's very efficient, it's very deep capital market, which enable large investors like us to have a prominent position if we wanted to progress and grow the sizing. So the deployment is going as planned, and there is a probability within the 10 years we deployed much more than the $500 billion.
How much do you worry about the short term? I mean, this Davos will be dominated by President Trump. There's been, since the beginning of the year, we've had Venezuela, concerns about Iran, and now there's the little thing called Greenland.
The short term is we'll be very worried with Tuesday and Wednesday logistics in Davos. Longer short term, I think in this market, as a large investor, we have to operate with both eyes open. One eye focusing on disruptions that are going on around the world. You have a tariff situation that is the highest since the 1930s. You have geopolitical challenges that are now global. You have some in South America, you have in the Middle East a couple of situations, and devastating humanitarian issues happening in Palestine and Israel conflict. And you have a major issue happening in Europe with the Ukraine-Russia situation. So those geopolitical challenges will effectively, if they prolonged, affect global growth and global inflation and global trade. The third thing, which is very important, I think, at the macro level, is the fundamental change that's expected to happen with technology. When we talk about technology, we're not referring to only the Apple of the world or the NVIDIA of the world, but I think the pace of AI innovation, if it becomes real, it will affect every industry, from financial institutions to industrials and so on. So this is in one eye what we focus on. On the other side of the equation, it's also very important to look into shorter-term disruption that are happening in capital markets. A tariff overall is a mechanism that creates inefficiencies in markets. And the major transmission that will happen is throughout currency volatilities, interest rate volatilities, varying inflation levels around the world. So while we need to be hopeful with the disruption and innovation and be focusing on investing, on the other side, you have to be very mindful of those challenges. So difficult question to answer. We do it through multiple things. The first thing is that investing in talent. I'm very proud to say that within QI, we have some of the best talents globally. We're focusing a lot on specializations, and we're focusing on growing up a lot of the talents that we have on the younger side of the institution. The second way we try to manage this is through strong partnerships. Large financial institutions around the world, large fund investors, and et cetera. And many times, not corporates, and many times we would align on alignment, but occasionally we'll have conflicting views on markets. So we have to have strong partnership that we trust, and can challenge us when they're wrong, and we challenge them when we think they have misperception. The third thing we're focusing on a lot is active risk management and proactive management, because you could be very long-term, but by the time long-term happens, I'm already retired. So we have to focus on being long-term focused, but very short-term aware. And it's not easy, because market dynamics never stop, and you have to test yourself and be humble to really focus on strengths and weaknesses in your portfolio and see how we deal with them.
Is it fair to ask what would be more disruptive, geopolitics longer term or AI?
Personally, I think AI. I think, geopolitics is a major, really driven by economical. It's very interesting. We look into the history. A lot of the global wars, unfortunately, had an element of trade. But I think with time, prices set at the right equilibrium at some point. Now, it's inefficient as well, because sometimes you push up prices up and you don't really de-inflate them. They can continue to be up and later on eat up in growth of those economies. On the AI space, it's very interesting. I think the revolution in AI as a new industrialization form is real, but we have to be patient. Each significant uplift on the industrial revolution have taken 30 to 40 years to materialize. If you look at a recent example, if you look into Amazon, which was listed in 96 or so, only became profitable in about 2003, 2004. The size of revenue grew from 20s or 11 or 15 million to later on about 5 billion in 2003, and continued to grow. But at the same time Amazon came up, a lot of players also came up. The players that were not successful on thinking about vulnerabilities in your business models and adjusting them have left the market. So the thing we worry about in innovation AI, it's short-term heat. The thing which we worry about AI is businesses that take momentum trades versus actually building business models that fundamentally prove to be valuable over the long term. But the whole purpose of revolution in the industrial space is really to increase the level of productivity. So what we yet to achieve and observe very openly is that AI would actually bring fundamental growth on the level of productivity. And you will find economies that don't really utilize AI in the right way, or industries, they will fall further behind. So it's a long-winded answer. I think geopolitical risks are real, but I think ultimately over the long term, the more fundamental drive to the future growth would come from AI overall. And the integration of AI. And AI is really not a lot of the, there's my technology team, I have the best technology team, I think, within various institutions, and they have very fundamental views. But generalists, if you think about it from a general perspective, there are very simple things that create productivity. And there is very complicated things around the agentic AI and the robotics coming against the world. And human always tend to not have limits and expectations. But even if you think of the bare minimum of improving productivity globally, there is a big room which AI would enable to happen.
So if we talk about AI valuations, first of all, can you tell the winners and losers today of AI in terms of companies?
Well, I wish. If we knew it, we would put all our commitments. At QA, we go by conviction. So we don't follow a strategy overall of spray and pray on those things. We focus on having deep research and building predictions, and ultimately have high conviction calls. I think materially some of the players will materialize much recent than others. We are large investors in Anthropic. We are a large investor in XAI. We are a large investor in Databricks. And we're investors in other businesses that are smaller in scale, but very fundamental in value. The team invested in Crest AI, for example. Crest AI focuses on optimizing and human augmentation of call centers. I think none of us want to be in a call with a call center for long. So it's actually real productivity. And I think the people would be on the other side would focus on more specialized and complicated requests versus the small requests.
How do you view companies adopting AI? So one of the trends that we're seeing is many chief executives spending so much time and money on AI that maybe it also means they have less entry jobs because they can't afford more people at the moment.
What I'll tell you for sure is no one knows the real answer. No one real answers of really utilizing AI the right approach. You have some institutions that will very forward-looking and focus on a lot of implementations that ultimately didn't really provide value. So there's a lot of optionality. But the most important thing that's fundamental for any implementation of AI is you have to have good data. So any business that does not have access to good data with what they do and conduct in their daily operations or their long-term strategic thinking would not be able to impose AI solutions in an efficient manner.
When you look at the sectors that you're focusing on or the areas that you're focused on for 2026, is it AI and something else? When I say
over the long term, we have a well-diversified portfolio. But what we've done last year is we've increased the level of tactical asset allocation. So in 2026, will be the large focus on AI that materialized and continue to grow. After 5-6 years of building a business, by that time, you should have a view on revenue projections and implementation and value add to productivity within those businesses and users. So those businesses will back more significantly. But the intersection between AI and in other industries is very important, is as important. Financial institutions, for example, are a large beneficiary of AI. Those who use AI in the right way will be able to be more efficient, have less compliance staff, for example, have faster processes in evaluating of customers. Industrial businesses is a major actor. I think when you think of a global geopolitical situation, we're definitely not in a position in 2001, 2005, where we are pro-global trade.
And that was Bloomberg's Francine Lacroix speaking with the QIA CEO. That's Mohammed Saif Al-Sawaidi. That conversation, of course, coming from Davos. We'll have much more from the World Economic Forum in Davos with coverage throughout the day and all through this week. Stay tuned to Bloomberg TV for that. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I'm waiting for one where I ask and you go, that was a shitty question.
Yeah.
I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Welcome back. This is Bloomberg Markets, a special edition of Bloomberg Markets because it is a US public holiday. European equity markets then under pressure, tariff threats once again dominating the agenda this January. Let's bring into the conversation Wei Li, Global Chief Investment Strategist at BlackRock, who joins us now to talk about, well, we have all kinds of things we could talk about, Wei Li, but let's start with tariffs because, of course, that's the subject of this weekend. Every weekend is dominated by something else, geopolitical of nature, it would seem. So your initial thinking as to how investors position for more tariff volatility, is that the right idea for 2026?
Good morning, Anna. I think how we think about tariffs last year, so specifically the framework of immutable laws, I think that framework applies very much here as well. So the first immutable law is around debt funding and U.S. treasuries, and the second immutable law is around centrality to U.S. supply chain. So if you look at, in the case of Europe, the first immutable law, Europe in aggregate, they are the largest holder of U.S. assets internationally. So that immutable law should be able to bind through kind of treasury yields potentially pushing higher, what that means for debt sustainability. Whereas the second immutable law around kind of centrality to U.S. critical supply chain is a bit less clear. Yes, EU and the U.S., they are the largest bilateral trade and investment partnership, but Europe does not seem to have kind of the industrial leverage over the U.S. like China does with rare earth. So maybe the first immutable law should be binding and the second immutable law less so. But the bigger picture is that this feels like the beginning of a negotiation, right? Like these are the opening gambits of negotiations. So